Before we begin the Capital Network's Emerging ASX Gems Investment Conference, we would like to acknowledge the traditional custodians of the various lands upon which we meet around our country today, and to pay our respect to elders past, present and emerging, recognising their ongoing cultures and connections to the lands of this country. Before our broadcast begins, please also be advised that all of the information provided today is general in nature and does not take into consideration your objectives, financial situation or needs. Before making any investment decision, you should always seek independent and licensed advice, which takes into account your specific circumstances. Welcome to the Capital Network's Emerging ASX Gems Investment Conference. We've compiled established speakers across a diverse range of industries to discuss emerging trends and ideas. In the hours ahead, you will hear from the top executives, directors, CEOs, managing directors, and industry leaders from ASX-listed companies. They will highlight how they are pursuing emerging trends and ideas to generate shareholder value. Each speaker will spend 10 minutes addressing a different aspect of this theme by introducing the company they represent, as well as their company's growth plans and upcoming catalysts. We do hope that you enjoy these voices and enjoy sharing their opinions. We would also love to hear your opinions and welcome you to join the conversation across TCN's very own social media platform.
Hi there, I'm Justin, CEO and founder of Camplify. So just a little quick introduction to myself. I've been involved in tech companies for quite a long time. The last company that I was involved in was also an ASX-listed company. It was also a tech company in the mining space. We took that company from a founder-led business here in Newcastle to being ASX-listed and then eventually being acquired off the exchange before I started my Camplify journey. I founded this company in 2015, and since then we've been on a significant growth trajectory. In particular, in the last couple of years, we've been growing the company at a overall growth ratio of a CAGR of GTV of over 90% and of revenue of over 90% as well. So we've seen really good growth opportunities, and we've expanded the company outside of Australia into the New Zealand, UK and Spanish markets. So just to give you a little bit of a quick background on Camplify. So Camplify, it's a little bit like Airbnb, but for caravans, campervans, motorhomes. So we provide a way for owners to connect together with hirers and provide all of the things that they need to be able to actually make that successful. So it includes roadside assistance, includes insurances, contracts, managing the booking funds, providing everything that those two parties need. So without us, they can't actually transact. So we are really the glue in the middle that holds that entire thing together. We make money through a revenue structure that's based on three key revenue buckets. So that's hire-related revenue or platform fees. So it's commission on every booking that we make, and that averages somewhere between 20 to 25% of the overall booking. Insurance revenue is our next key bucket. So that includes insurance on the owner and hirer side. So the owner pays us a fee to have their vehicle insured, and the hirer pays us a fee to reduce down their risk from a high cost per incident down to $500 per incident. So we make insurance revenue on both sides, and that operates at quite a reasonable margin, that product. The last key bucket is product sales. So that refers to all of the goods that we sell to our customers. So that can range from everything from another electronic brake controller, a trackable GPS unit, right up to us actually now selling vehicles to our customers through our relationships with manufacturers. So we've been able to go out and source really good deals direct from manufacturers and then provide them to customers on an on-order basis, so that we don't hold any stock, we don't hold any risk, but we get to provide a great clip of the ticket along that transactional path, and the customer gets a better deal than they could if they just walked in off the street and bought a new vehicle. So a little bit of some key things about us. We're in a really dominant position here in Australia and also in New Zealand, but we have a lot of growth to continue to go. At the moment in the Australian market, we have around 8,000 vehicles, but there's over almost 800,000 vehicles available in Australia to be listed. So we know we have a huge amount of growth to go with very little competition in this space in the Australian New Zealand market. We have a take rate that's growing over time. So in the last couple of years, we've grown that from 25% up to just under 30% in the last 12 months, and we're continuing to see that grow. And we have customers who are returning to us, 1 in 4 people rebooking their next holiday with us. So we've got a really good loyal returning customer base. We're a very capital light model, so we have an easy way to enter and operate in markets. We don't have any debt, and it's very scalable. So as we get more and more customers, the return per customer gets larger and larger, and the investment that we've made in the core platform and core business remains flat. So over time, we'll continue to see a really good scaling effect in the business. Our unit economics are really attractive. So we acquire a customer for around about $256 and a hirer for about $13, and our average booking value was over $1,200. So we get a return per customer really quickly, and it's very attractive in terms of the way that we can scale it. We've been consistently hitting growth numbers in our GTV, our bookings, our fleet, and our revenue, and we've been doing that over the past 4 years at a really consistent rate, and we see no reason why that will stop. We're a founder-led business. We've got a very experienced management structure and a very experienced board as well. So some key dates coming up for us. We have our AGM being held on the 16th of November. That'll be held in Newcastle. We have our Q2 4C results will go out in the end of January. And we also have our half-year results will go out in mid-February. So thank you very much, and look forward to you following along with our journey in our stock.
Okay, thank you very much for having me this morning from the Capital Network. My name is Dr. Tom Duthie. I'm an Executive Director of Index Therapeutics Limited, and I'm delighted to present some highlights of our company to you today as part of the ASX Gems conference. This is our standard disclaimer. Just in terms of the company snapshot, I draw your attention firstly to the left-hand table there. So we are a biopharmaceutical drug development company with a single drug asset called Presendin, which is a sustained-release exenatide formulation. Exenatide is an existing approved drug. We are repurposing this drug for an orphan disease called idiopathic intracranial hypertension, or IIH. A bit of a mouthful, but I will come to what that indication looks like shortly. We are at phase 3, so we are running a single phase 3 clinical trial to determine the effects of Presendin in IIH patients, which, if successful, will see our drug registered in the United Kingdom, Europe, and Australia. We have orphan designation granted in the United States and Europe and the UK, and our market opportunity is significant. So $1.6 billion annually across those 3 markets, US, Europe, and the UK. This current IIH market platform, there is no existing approved drugs, and we are the only clinical stage drug company with a drug program in IIH currently running a late stage trial. So a very good opportunity upon clinical regulatory success. And we also have a number of issued and pending patents to protect the core intellectual property over and above our orphan drug designation. Our capital structure is very straightforward. Our market cap of around 42 million. is pretty skinny relative to the stage of development, but I draw your attention to our current cash position of 29.3 million. So this cash position fully funds this phase 3 clinical trial through registration in those markets, as I've mentioned. And that's a very fortunate position for the company to be in at the moment, in that we're not required to raise further capital to fund that trial. Our enterprise value accordingly, which is the market capitalization less the cash, is just 12.8 million. Our directors and management have significant drug development experience. Our chair, Jason Loveridge, Professor Alexandra Sinclair, who's a co-founder with Dr. Loveridge, and our chief scientific officer. She is a practicing neurologist and has substantial experience in the treatment of IH, and also has run a number of clinical trials in IH. So we're very fortunate to have Alex with the company. Dr. Megan Baldwin, some would know as the current CEO of Pty Ltd. Our register, top 20 own about 58%. Tadarang is our largest individual shareholder. The executive summary. So as I mentioned, we're a late stage drug development company and we're targeting IH. So this IH indication has very attractive market dynamics. It is unencumbered. As I mentioned, there are no approved treatments, no treatments in clinical trials beyond ourselves. And there's actually there's an urgent market need for therapies for IH, with an IH patient requiring our intervention, Presendin, will be on that drug Presendin for an extended period, as this will be chronically administered. So from a lifetime value perspective per patient, it's also an attractive market dynamic. We have clinical data that supports and underpins our thesis that Presendin, sustained release exenatide, could be effective in IH, in that our phase 2 trial data was very strong and showed a sustained drug effect in an IH population. Importantly, we had no safety or toxicity concerns over an initial 12 weeks of daily treatment. And our single phase 3, which is targeting the UK, Europe, and Australia, will meet and hopefully exceed the requirements for registrations in those markets. The barriers to entry I've mentioned, we have orphan designation, which confers 7 years market exclusivity in the United States and 10 years in Europe. And we have issued patents with additional patents pending. Our milestones for the second half of this calendar year, and an investment opportunity for this business for potential investors, and of course existing shareholders will reap the benefits of our success. We have additional regulatory filings that we're in the process of completing and awaiting approvals on. So we have recently, in the last couple of months, achieved investigational new drug application, or IND, with the Food and Drug Administration in the US to commence US clinical trial sites, and that was achieved in August. We have approval for public hospitals in Australia in September, and we're awaiting at least 3 more regulatory clearances to commence our phase 3 trial in New Zealand, Israel, and Europe. We see ourselves progressively opening clinical sites this half, and our first patient is very likely to be recruited and dosed either in Australia or the United Kingdom this half as well. So a very rich vein of news flow and milestones for us this half, and we're very excited to deliver those progressively over the coming months. An investment opportunity in this business is really geared around the success of Presendin. So our phase 3 trial is designed to support Presendin market approvals. As mentioned, it's very unusual for drug development companies to have an unencumbered market opportunity, and that is a function of IH being an orphan disease, in that there are no existing approved treatments. It's quite rare, so biopharmaceutical drug development companies tend not to focus on rarer diseases. Importantly for us, though, if we are successful, it is potentially Presendin will be the first ever regulatory approved drug for IH in any jurisdiction across the globe, and that is a huge achievement for a small biotechnology company in Australia. And we believe that there's really rapid potential here for Presendin to be incorporated into treatment guidelines and for it to be utilized clinically. So let me just pause for one moment on that aspect. Typically, a treatment guideline is a recipe book for practicing clinicians in how to treat a patient, and the level of evidence within those treatment guidelines is typically very high through large randomized controlled trials. So if you get incorporated into the guidelines, you have both rigor, diligence, and success as a drug, if you like, in the clinic. The utilization is important, of course, because a doctor currently who's treating these patients has no intervention or drug-based interventions to treat, and therefore the utilisation, if we are successful clinically, will also be quite high, we believe. As I mentioned from the outset, we are fully funded with almost $30 million in cash as at the end of FY22, 30 June, and we exited the financial year 2022 with core corporate overheads of just $1 million per annum. Everything we do is geared towards the development pipeline and the development program. With that, I'd like to conclude today's presentation and thank everyone for listening in today. Thank you very much.
Hello, my name is Richard Lipscomb. I'm the Managing Director at Proteomics International, and today I'm going to give you a snapshot of how we are hoping to create a world where disease is detected early and cured simply. In doing so, we're going to improve the quality of lives of patients across the globe. We're going to save governments and healthcare systems millions, potentially billions of dollars, and make money for our shareholders. Proteomics International is a medical technology company at the forefront of the area of precision medicine and predictive diagnostics. Our lead product is a diagnostic test called ProMarker D, which can predict and identify diabetic kidney disease in the early stages. It's a test that's revenue ready, cost effective, easy to use, patented technology that's starting to roll out globally. It's part of a strong panel of diagnostic tests that we have in development across a range of chronic diseases. We also have a bioanalytical services division that meets some of the growing demand from industry for specialized analytics. The revenue from that business helps offset our cash burn from research and product development. And both of these activities occur from our state-of-the-art laboratories here in Western Australia. On the corporate side, we recently had a very successful placement, raising $8 million. We also attract funding for manufacturing to support the products that we have in development. Together, this has allowed us to implement expansion strategies and to accelerate our growth. We've recently hit a number of milestones which position us very strongly from the corporate perspective to take us through 2022 into 2023. Very exciting times for our business. Our point of difference is a platform technology which we call ProMarker. This technology platform identifies unique protein biomarkers, fingerprints, if you will, that you can find in a drop of blood. The platform identifies and links these unique fingerprints to specific diseases. This enables us to create novel diagnostic tests. These become our intellectual property that we can sell. ProMarker D is our test for predicting diabetic kidney disease. It's going to change lives around the world. Why do we need this? We all know diabetes is a problem, but you may not have been aware that over 500 million people worldwide have diabetes today. And 1 in 3 of the adults with diabetes already have chronic kidney disease. The reason this is such a high number is because kidney disease is a silent killer. You can lose 80% of your kidney function and you wouldn't know. You might start to feel a bit lethargic. But at this point, your kidneys have already been irreversibly damaged. So early detection is key. Without early detection, diabetic kidney disease leads irreparably to dialysis or kidney transplant. Both very expensive outcomes. In the US alone, $130 billion per year. Why are we in this predicament? Because the current standard of care diagnostics, which have been around for 50 years, simply aren't good enough. They can only detect the disease once it's already developed. They certainly cannot predict the onset of disease. And so that leads us on that path to dialysis and kidney transplant. The solution that we've developed is ProMarker D, a test that can predict the onset of disease before clinical symptoms appear, up to 4 years in advance. Doctors then can prescribe early therapeutic treatments to slow or stop the onset of the disease. It's the old adage that prevention is better than cure. We can then save healthcare systems billions of dollars and improve the quality of lives for patients. The ProMarketing test is easy to use, simply integrated into existing testing regimes. We take a standard blood draw, and that sample is then analysed in the laboratory to find those biomarkers, that fingerprint. It uses a standard technology platform available in all laboratories around the world. And then the results are uploaded into the ProMarketing Hub, which is a cloud-based algorithm that develops a report identifying the risk that that patient is at. And that report goes on to the doctor so that they can manage the treatment regimes for those patients. There are new drugs which have recently become available for diabetic kidney disease that can slow or stop the progress of the disease. So this is a game changer for those patients, but we need to know who to give the drug to. And again, the earlier we give the drug, the better the outcome is going to be for the patient. Much easier to cure somebody who's only got early stages of disease rather than waiting until late stage. The route to market for ProMarketing is also straightforward. The diagnostic company licenses the test. The kits are now being made in Europe. We've recently completed a number of milestones there to ensure we have product made to international manufacturing standards. And as I said, the laboratory can run the test. The samples are all collected by that laboratory, processed by that laboratory. The results are submitted to the hub and the reports are generated. And PIQ receives a royalty on every test that's sold. We have a number of licensing transactions completed and in progress. Two very important markets in different ways, Britain and Israel. Britain, with the National Health Service, is a very attractive market because it's effectively a one-stop shop. The potential to get approval by the NHS and sell across the whole of the UK. Israel, exciting for different reasons, a market that likes to bring in new technologies quickly. We've recently had great progress in the US, where we signed a binding letter of intent with Sonic Healthcare USA. Very exciting opportunity there, and the test recently went live through Sonic Reference Labs. We're targeting markets around the world, key markets generating new revenue streams. Our diagnostics pipeline is rich. We target areas of significant unmet need, enormous markets where lots of people are affected and there are no good diagnostic tests. This enables us to target markets with large revenue potential. Following in the footsteps of diabetic kidney disease, we have tests for endometriosis, lung disease, other complications of diabetes, and esophageal cancer. I'm going to focus on a couple of these briefly. Endometriosis, a condition which affects 1 in 9 women. Diagnosis currently takes 7.5 years on average, requires invasive surgery. It's simply not good enough. It takes that long to diagnose. We know we can do better. In recent results, we've announced we could identify 8 out of 10 people with the disease. We have a potential world-first blood test for endometriosis. Esophageal cancer, it's a very nasty cancer. 1 in 20 cancer deaths worldwide caused by esophageal cancer, 5-year survival rate less than 20%. Very expensive disease to diagnose and to treat. It's actually caused by acid reflux that leads to a condition called Barrett's esophagus that can eventually lead to cancer. Again, we think we can do better. In our prototype test, we identified 9 out of 10 people with the disease, results recently presented at the World Congress for Esophageal Diseases. Further work is required in these to finalize the test, but again, we have the potential for a world-first test for esophageal cancer, and we continue to work with world-leading medical researchers and clinicians to develop these tests. The share price catalysts for Proteomics International for this financial year, the licensing deals will continue. We'll finalize the license with Sonic Healthcare in the next few quarters. That's our expectation. Other licensing deals to come. First sales across a range of markets, but that's the potential, all of which will drive revenue. Reimbursement, very important for the US. What is known as a proprietary laboratory analysis code, a PLA code, which secures reimbursement. We'll know the outcome of that in the first half of next calendar year. That can lead to payment by the insurers and the healthcare systems. Other regulatory and reimbursement submissions around the world, all building confidence in the test. As I've just said, our pipeline is rich, and our test for endometriosis and esophageal cancer will know whether we have new first-in-class diagnostic tests for those in the first half of the next calendar year. The pipeline remains rich, and other tests coming through, all of which will develop new intellectual property, potential new revenue streams for our company. So in summary, we have an exceptional global opportunity. We've got disruptive, cutting-edge technology, a proven in-house diagnostics platform. The ProMarket test has been de-risked, patented, and is revenue ready. The test is rolling out in easy-to-use format. It's very scalable, it's low cost with high margins. We have whole of market appeal from the drug companies who are developing the new drugs for diabetic kidney disease through to the diagnostic labs, and then governments and physicians who are all trying to improve the outcomes for patients with diabetes so that we can stop the tsunami of dialysis that's coming our way if we don't change current standard of care. We have a deep pipeline of potentially globally significant tests in development. This is a vibrant sector with enormous interest in precision medicine and now an awareness of the importance of diagnostics. This is an exciting time for the field. We are ideally positioned to take advantage of it. We're looking forward to a very exciting 2023.
Hello, Steve Littymore, CEO of Immuron Limited, listed on the ASX, IMC, and NASDAQ, IMRN. We are a globally integrated biopharmaceutical company. And for a small biotech, we're a little bit unusual in that we have commercial products as well as a pipeline. 2 commercially available oral immunotherapeutic products, Travelan and Protector, generating revenue, 3 pipeline assets and 4 clinical programs. Our current market cap is around $18 million, and at 30th of June, we had $22 million in cash. We've recently refreshed management. I joined recently in June. I've just hired Flavio Palumbo as Chief Commercial Officer to work on commercialising our Travelan and Protector and growing them. And Joanne Casey as R&D Manager, PhD, with experience in antibody development. Our flagship product, Travelan, is once again in demand as global travel rebounding. The addressable market continues to grow, and Immuron expands its distribution capability into FY23. We are also capable of producing highly specific orally active immunoglobulins for any enteric pathogen. That's about our pipeline. I'll talk a little bit more about that later. Currently, we're completing an assessment of our entire product portfolio, target markets, competitive advantage, and growth drivers, looking to generate shareholder value. We'll pursue organic growth and M&A to expand commercial product sales within our existing and new geographies, and also to increase our product offering. We've just started the process. We signed a subscription and option agreement with leading gut health biotech, Arteria Health in the UK, who recently launched groundbreaking Juvia for irritable bowel syndrome. Just quickly on our FY22 results, we exceeded our budget by 92% in revenue. We have a strong balance sheet supporting our growth strategy and M&A strategy. The strategic investment in Arteria Health is the first milestone in this journey. We have an important relationship with the US Department of Defense and a grant of US $4.45 million that's being applied to Travelan or IMM124E, develop a product more suited for military use. We're set to file an IND with the FDA and to initiate a clinical trial this financial year. Quickly stepping through to our pipeline, Travelan, IMM124E. You can see here we're just about to start a traveller's diarrhea ETEC challenge. So this is a controlled human infection model challenge study funded by the US Department of Defense $4.45 million US grant. We've just recently appointed Pharmaron as the CRO, and the IND is anticipated to be filed within the latter part of this calendar year, with trial initiation in the first half of next calendar year. Our other program, IMM529, is for Clostridioides difficile, serious infectious disease. We've just undertaken through Lumanity in the US an evaluation of both of these products, and we're pleased to see that they're still well positioned to be competitive in both of these market settings. Our partnered clinical programs, you can see down the bottom here, The Uniformed Services University is conducting a field study of Travelan in conjunction with another potential product for travellers' diarrhoea in high-risk regions, and also Camp ETEC. So this is a Campylobacter and enterotoxigenic E. coli through the Naval Medical Research Centre. Stepping through to the addressable market, you can see that we're playing in a large market space here. The global digestive health market is a multi-billion-dollar market. Travellers' diarrhoea in of itself is a large market and growing rapidly. Our investment in Ateria, just announced recently, is in the IBS space, which is also a large and growing market. Travelan has a large market potential. Acute diarrhoea affects millions of travellers each year. 30 to 70% of travellers experience travellers' diarrhoea. And looking at market potential, in the US alone, it's around $83 million based on a penetration rate of 15%. And in the EU, $50 million. So that investment in Ateria, we're looking to launch in the UK initially through them. We'll be attacking that market potential. The Clostridioides difficile market, you can see, is estimated to be a $1.7 billion market. Plenty of space for us to participate in that area there. As you can see, and just in summary, we are a company with 2 commercial products, 3 products in 4 different clinical trials with a lot of potential for future growth. Thank you for listening to my presentation today.
Thanks everyone. My name is Blake Burton and I'm the Managing Director of DC2. So just a bit of a disclaimer for everyone to read prior to the presentation. So a bit about DC2. We're a vertically integrated provider of data center and cloud services. In the last 18 months, we bought 3 data centers online. The first and biggest being our Bibra Lake data center. Bibra Lake's a southern suburb of Perth, and it's right on the doorstep of the Henderson Marine Park. It's a massive industrial complex south of Perth, and we're actually the closest data center to that area. So our Bibra Lake facility, a few months ago, we got our Tier 3 design accreditation, and it's a really important accreditation for us to have. Essentially, an independent institute, the Uptime Institute, they come through, they review your data center, and with a Tier 3 accreditation, they certify that we can keep our customers' data online 99.982% of the time. And it is really, really important for us to have, because Tier 3 is the minimum accreditation that we need to host customers' equipment for large enterprise customers, government contracts. So it really does underpin that future growth for us. Separately, we have our regional modular data centers. So these are just containerized modular data centers that we put directly on renewable energy sites. The first site for us was our Midwest site. So it was in the Midwest of Western Australia, directly on a wind farm, 2 megawatts of capacity. That's fully operational, that's online, that's revenue generating. More recently, just a few months ago, we brought online our Victoria data center site. So that's on a biogas site. It's 100% renewable energy, so strong ESG credentials. Our Midwest site is on a wind farm, so majority of it is renewable energy, but when the wind's not blowing, we do have to go onto the grid for backup power. So our Victoria site, we got really excited about because it is 100% renewable. So that came online in August of 2022, initial 800 kilowatts of capacity. Majority of that, just under 800 kilowatts, we've actually already signed up a customer contract. It's around $1 million a year. So they're online. We're in the process of bringing online all their equipment. So majority of it is online now. And what we also have done separately is we build these modular data centers, we sell them to customers. This particular site, this energy provider, we built them a modular data center, so that's online on their site. And we're in the final stages of negotiating with them, actually getting 400 kilowatts of capacity from their modular data center, which we can then on-sell to our customers. So that'll bring that site up from 800 kilowatts to 1.2 megawatts. Lastly, we have our DC2 cloud platform. So this is a sovereign cloud platform. And what I mean by that is it's hosted right here in Australia, but we're also an Australian company, so we're only subject to Australian laws. Your hyperscalers, the big cloud providers like AWS, Microsoft, Azure, yes, you can have your data hosted here in Australia, but you are subject to foreign laws, to those foreign political jurisdictions. For us, our competitive advantages is purely Australian. Now that's online here in Perth at our Bibra Lake data center, but we've also set up a point of presence up in Darwin, which we're currently expanding. So we've got the 2 locations for that cloud platform. Another competitive advantage for us is that we have what we call a hybrid, or what everyone calls a hybrid cloud solution offering. And what I mean by that is typically a customer would go to Azure or AWS for cloud services. They might go to NextDC for data center services. We can offer a customer both. If a customer comes to us and says, I've got my own kit, which I want to manage myself, or it's an old system, so I can't yet convert it to the cloud, we can offer them those co-location services, while also saying that we can offer you these cloud services as well. It's a hybrid solution. And over time, if they want to convert that all to the cloud, we can do that. Or if they want to keep that hybrid cloud offering, we can continue to do that as well, where other providers, you'd have to go to this provider for cloud services, that provider for co-location services. We can offer them everything. We've had that consistent revenue growth. So we've had 6 quarters of recurring revenue growth, which is really exciting. What you'll see here is there has been some one-off revenue. Like I mentioned before, we sell modular data centers. We also sell things like phone systems or services. We'll take any money that comes our way. But our focus really is on growing that recurring revenue, having that consistent revenue coming in month on month. Now, I stepped up as Managing Director of DC2 in July 1st of this year. And over the last quarter, what we've really been focusing on is restructuring the team. We had some staff redundancies, some existing staff. We've actually changed their role within the business. We've created a real clear line of reporting, real clear distinction there. So there's a full restructure. We also went to certain suppliers, renegotiated contracts with them. So the exact same service, we said we want a better price for what we're paying for. They've given us that price reduction. The end result is we've cut out about $500,000 a year from the business. Our previous MD, Justin Thomas, he's now our CTO. He had some performance shares along with our operations manager. We've mutually agreed to cancel those performance shares as well, so there's less dilution for shareholders. We brought in an employee share plan. We think our share price at the moment is great value, and we want to incentivize employees to get that moving in the right direction. Like I mentioned, Bibra Lake, that's now Tier 3 design accredited. The next stage is to get that Tier 3 construction accredited. We've commissioned our Victoria data center. And I haven't mentioned this one, but we do have a little Tier 2 data center in Osborne Park. Tier 2 data centers are going out of fashion. So we've decided, look, we're going to shut down that data center. All services, we're moving them across to Bibra Lake. Then we'll shut down that data center. End result is there'll be more cost savings. So why invest in DC2? Recurring revenue, it's a nice model to have. You have that consistent revenue coming in month on month. We recently completed a capital raising. So we did a $1 million placement. We're also doing a $1 million, up to $1 million SPP for existing shareholders as well. So we're really well funded for that next stage of growth. We've just completed a restructure internally as well. We've got the right people in the right positions. All our data centers, we spent millions of dollars over the last couple of years bringing these data centers online. So they're now online. The next phase is to get them utilized, to get customers in and get that recurring revenue growth. We've got a strong pipeline of sales. So the idea is there, the guys are out, they're on the street, they're quoting jobs. It's now just a matter of converting them. We're looking at offering we are starting to offer additional services as well. Traditionally, we've offered data center services, cloud services, just infrastructure, but we've had customers coming to us saying, can you offer me an NBN service, a direct link from your data center to my office? Can you offer me voice solutions? Can you offer me professional services, management, cybersecurity? And traditionally, we haven't offered these services, but now we're starting to do that. We're starting to increase our product suite and offer these services that customers are asking for. As part of that as well, we're actually investigating potential acquisitions. So acquisitions of complementary businesses, services that we want to offer our customers, that our customers are asking us for anyway. We want to acquire companies with those complementary product offerings so we can get that revenue coming in much quicker, but then also offer those services to our existing customer base. As part of our strategy, we're going to look at expanding into other states. We're already in Perth. We really want to start ramping up Darwin. We want to expand into the smaller states, Brisbane, Melbourne, Sydney. Everyone does like these big states or these big cities, these big markets, but they're also highly competitive. What we've decided is cities and states like Darwin, South Australia, Tasmania, there's still millions of dollars to be made in these states. So we're looking at expanding into these states either organically or through acquisition. Lastly, I'll mention that we've reviewed all of our assets as well, and there are some that we've identified as non-core. It's still very early stages, so there's a disclaimer there, but we're looking at selling some of these non-core assets as well to further bolster our balance sheet, get more cash in the bank so we can execute on the strategy that I just mentioned. So like I mentioned, my name is Blake Burton. My email address is on this slide. If you have any questions, please feel free to reach out.
Hello, my name is Ian Dunstan. I'm the CEO and Managing Director of Gratify Limited. We are a specialist loyalty and rewards software company. We've been listed on the ASX for 4 years now, and we've certainly been delivering. It's certainly working in a very exciting part of the market at the moment. So yeah, as a company, we have around about 60 employees now with 6 offices around the world. We have over 85 enterprise customers. Last year, we turned over just under $18 million, and that's growing quite substantially into this financial year. Current market cap is around $20 million, and we have about 957 million shares on issue. What we do find exciting is the area that we're working in has been particularly strong since the end of COVID. An interesting statistic is that over 60% of companies in Australia have increased or significantly increased their in development of their loyalty strategy since the end of the crisis. The other interesting thing is that pretty much every company, when you think about it, other than mining companies, will have a loyalty and rewards program. So that's a matter of retail companies, hospitality, financial services, health, telcos, travel, tourism, insurance, and sports and recreation. So all companies within these different sectors will have some form of loyalty strategy and loyalty program. What is special about the Gratify business model is that we provide 3 pillars to our solutions. There are a lot of players out there in the market that will provide one piece of the puzzle, but as far as we know, we're the only supplier that will supply the front end and the engagement and marketing, the loyalty engine in the back, which is our SaaS API platform, and then also we provide the rewards. So we source and supply market-leading rewards for companies, and we deliver all 3 parts of this as a seamless solution. So you don't have to get your front end from one supplier, your loyalty engine from another, and your rewards from another. We're able to provide all 3 parts of that to give you a seamless solution. And that's what we found to be very attractive in the market. This allows us to deliver a complete solution for mid to top tier enterprises. We don't operate particularly in the SME sector. We tend to operate in I think our sweet spot is between about $200,000 to $500,000 a year from our customers. So you can see from this table that we're the only supplier that we're aware of, particularly in Australia, that can provide all of the components that you need to deliver a seamless enterprise loyalty and reward solution. We have, as you can see, all the pieces that people are looking for. The third-party rewards is a fast-growing part of our business. We recently acquired Chico to give us the front-end development and engagement piece, which we had been lacking, and we can now deliver that, which again has led to a strong growth in our revenues and pipeline. If we look at how the company has progressed over the last 2 years, you can see that we've grown our revenue by around about 6-fold in the last 2 years. And as we've previously announced to the market, we believe that the next quarter will be a continuation of that double-digit growth through September. And as historically, Q2 is a very strong quarter for us because loyalty rewards are very strong over the Christmas period because of retail sales and school holidays. That will be a strong period for us as well. So we expect to see that double-digit growth go through September and then further grow again in the December quarter. So the future is looking particularly strong for us. So our competitive advantages are, we deliver better innovation through our Mosaic SaaS platform, which has seen exponential growth since its launch last year. We've now added the engagement piece for the Chico, which gives us a competitive advantage there in that we can design the products as well, to design the apps, design the web front ends, and deliver that piece. And then we have the final piece of the puzzle, as I said, the rewards, which can be anything from movie tickets to travel to dining. We have thousands of suppliers now, allowing us to deliver a broad range of tailored rewards specifically for each company as they require them. And we believe these three pieces of the puzzle coming together allows us to have a very unique offering, which the market is finding very attractive, hence the strong growth that we continue to deliver.
Today, I wish to draw your attention to a copper and gold mining project located in Oman, in the Middle East. As we all know, that global demand for both the metals, that's a copper and gold, has never ceased since Copper Age, several thousand years ago. Copper is essential for modern life. There is about 30 kilograms of copper in each of our car and about 180 kgs in average modern home. The consumption of copper is expected to grow even more with onset of electrical vehicles and urbanization of rural populations all over the world. Supply, on the other hand, has a rough future. Since its inception around 2009, Alara has been actively investing in exploration of base metals, with some special focus in Middle Eastern countries. In Oman, we have carried out scientific exploration programs over 1,000 square kilometer area in 5 different exploration licenses and completed several JOC compliant feasibility studies. The picture on the screen shows one such project which is under construction, where Alara became the first foreign company to get mining license. These are our statements. Every resource figure mentioned in this presentation is signed off by a competent person who is a member of Australian Institute of Mining and Metallurgy. About Alara. Alara is a mineral exploration and now a mine development company with a registered office in Perth and most of its operations in the Middle East. In Oman, we have 4 projects or 4 companies and different joint ventures where Alara holds 50% and above. In all these companies, there are several exploration licenses for copper and gold. One company, which is ARL, Resources Limited, has 35% stake of Alara, and it is an exploration service providing company. The main project that I'm talking about is Washihi Mazaza Copper Resource. By exploration and evaluation studies, Alara has identified JORC resource of copper totaling up to 16 million tons, averaging about 0.88% copper and about 0.22% gold. With the mining studies, we have now defined reserves, and with the ore inventory in different categories is about 10 million ton, which would form a base for this project, which will last for 10 years, processing about 1 million ton of copper ore every year, producing copper concentrates on an average 30,000 per year. A quick look on the project and activity which is currently going on. The project is going through standard process of engineering, procurement, and construction. And you can see engineering is almost complete. Procurement, most of the equipment for the plant have been ordered. The construction is in full swing and it actually started last year around same time. The mining pre-stripping is in progress. We started to see the light of copper ore now, and we have started to receive the equipment that we have ordered. The project is scheduled to be commissioned in April 2023. The project has impressive financial despite its smaller size. The table shows them at different price points of copper. The copper price in previous quarter touched $10,000 per ton. At today's LME copper price, which is around $7,500 per ton, the project will deliver NPV of $71 million over 10 years. All forecasts indicate copper price to escalate further after current pandemic and the war crisis. The picture on the screen shows the location of the project with respect to the port where our concentrates will be shipped out. There is also a copper smelter which is currently defunct, but may become operational in future. So in summary, the construction of Oman-based Al-Washihi Mazaza copper project is progressing quite well. Key equipment consignments continue to arrive on site. The mine pit itself and other infrastructure components well on the way to the completion. Al-Washihi Mazaza project remains on track for completion in June 2023 quarter, working towards delivery of license renewals and license application for other Omani projects. Thank you very much.
Hello, everybody. My name is Riccardo Canevari. I'm the CEO of Radiopharm Theranostics. So glad to be here. Radiopharm Theranostic is a biotech startup with an important ambition, and is to become a leader in fighting cancer, leveraging the innovation of radiopharmaceutical therapies. And radiopharmaceutical therapy really represent the new pillar in oncology. There are such an amount of evidence on how these products can help patients with different oncological disease, in particular solid tumor, to fight cancer. So we are excited to give our contribution to this field. And Radiopharm is a pretty new company. It was funded in February 2021. We went through the first capital raise at the mid of last year, and we became a public company listed on the ASX in November. So of course, exciting times. We do have a highly prospective portfolio, so 6 different platforms and 9 molecules that are addressing different areas in oncology, from high prevalence disease, for example, lung cancer, prostate cancer, and breast cancer, to other areas that are less common but equally important for the patient, even if the prevalence is lower. We have the plan to work in areas like glioblastoma or osteosarcoma that are very important, high unmet medical need. So we do have a very broad pipeline, probably one of the broadest among companies working in the radiopharmaceutical space. And we made a number of progresses in the last few months. And in particular, I like to highlight 2 strategic collaboration. One on the industry side with a global leader in imaging like Lantheus, where we do have a partnership ongoing, where we develop the same molecule where Lantheus is developing for imaging, and we as Radiopharm Theranostics develop the therapeutic version. But also more recently, a very important partnership with the #1 institution in US in terms of cancer care, MD Anderson Cancer Center. We started recently a new company together called Radiopharm Ventures, and we plan to work very close with MD Anderson to develop together important molecules in the space of radiopharmaceutical therapy to address additional area of unmet medical need in oncology. So we are very excited. But also, I like to share that we recently presented what is our first clinical milestone since the IPO. We were looking at those data, of course, with a lot of attention. And I'm, of course, very excited that now we are out in the market with this communication that our molecule called Pty Ltd delivers positive phase 2 data in a specific trial in brain metastasis. This is very important. It's a phase 2 data, positive results for our imaging agent in an area like brain metastasis. Probably not everybody is familiar, and sometimes when you speak about brain metastasis, people think about brain cancer like glioblastoma. That is quite, fortunately, a rare disease. Brain mets instead, these are secondary tumor generated by other primary tumor in the rest of the body, and is very, very frequent. About 400,000 people every year in US are diagnosed with brain metastasis. So a large population, and for this population there is an important medical need. They need to have a better imaging agent to follow the brain mets. Are these increasing in size? Are they reducing in size? Is the therapy that the patient are using working? And having a very appropriate, tailored, specific imaging agent for this population is very important. And that's what is the trial about. So we were able to deliver positive results because Pty Ltd was able to, when injected to patient, to cross the blood-brain barrier, arrive to the brain, and being selectively uploaded in the brain metastasis. So when a patient then goes under a PET scan machine, the PET scan machine is really able to see where the tumor is, how large, and how is evolving. So exciting data because Pty Ltd show the positive results, so was able to be uptake and was able to deliver very important images for the physician to better decide about patient management. And as always, as we are in the pharmaceutical business, it's important that the benefits are not associated with side effects. And in fact, our phase 2 trial was able to show a very positive safety profile. So we believe there is a very important business opportunity. Brain mets is a large segment in oncology, is even bigger than one of the largest area like prostate cancer. So we put together a model to understand what is the market opportunity in this segment, and we arrived to a conclusion that is more than $1 billion per year, the market opportunity, if a company is able to bring products to the market in this area. And we, as Radiopharm Theranostics, now with a positive phase 2, are planning to start a discussion with FDA to be sure that we can start a phase 3 and being only one trial away from FDA approval and commercialization. So exciting time for the molecule called Pty Ltd, able to bring innovation in the imaging segment for patients with brain metastasis. But we don't have only Pty Ltd. We, as Radiopharm Theranostics, we have other 5 additional pillars looking at different tumor types, where our ambition is not only imaging, but also deliver therapeutic solution. For this reason, we are really targeting important area, and we plan to start 4 new phase 1 clinical trials in the next month or 2 months. 2 trials in Australia and 2 trials in US. So an exciting times because we foresee in the next 12 months a significant news flow. We would like to keep the market updated with the enrollment of the trial and the results of the trial. So again, on the backbone of the positive phase 2 results with Pty Ltd, we have much more to do, and we like to keep the market updated as soon as it is possible to share more information. So for this, I just like to share the commitment of the management team of Radiopharm Theranostics. All the team is fully focused in such an important mission of bringing new hope to patients living with oncological disease.
The two key services that CLUI delivers are curriculum-aligned learning and or extracurricular learning. Firstly, our core academic support service, which takes the form of one-to-one and small group online tutoring and test preparation, is all aligned to the school syllabus and curriculum. And we deliver these services in Australia and New Zealand across maths, English, and the sciences. We also offer test preparation as well as online self-directed practice sets. It's important to understand that the core CLUI service is not a marketplace. We recruit and train all the tutors, and we quality assure all of the tutoring using data and learning analytics. And all the content used by our tutors has been developed by CLUI and is delivered using our proprietary, fully synchronous live online learning platform that incorporates the content, the live video and audio, and whiteboard functionality. The service we offer is not tutoring on demand. Rather, students typically enroll in ongoing weekly CLUI learning programs that are personalized to their individual needs with clear academic goals. The other service that we provide is or extracurricular learning in the form of holiday camps, after-school and online learning programs. And our focus in this area is on coding and digital skills, and we deliver these services through our CodeCamp subsidiary. Over the last 4 years, we've seen a transformational shift to online learning by school-age students. And this shift happened long before COVID and then accelerated further during COVID, when close to 90% of the world's school children were forced to learn outside of the classroom. Another trend we're seeing is that parents are also spending significant amounts of money on or extracurricular learning, particularly in areas around computer skills, digital literacy, and other interest-led areas. Over time, we've developed and deployed extensive data and learning analytics in order to optimize every learning interaction and the learning experience. We've also extended our services through subject and geographic expansion that enables us to capture an increasing share of the wallet spent on learning outside the classroom. The market we operate in is large. In Australia and New Zealand, there are approximately 4.8 million school students, and around 40% of these students used or considered using tutoring in the last 12 months. Furthermore, an additional 52% of students use or consider using other forms of curriculum-aligned learning. And post-COVID, the propensity to consume learning support has been amplified by the fact that gaps in learning have increased. During COVID, most parents were required to support and assist their children with their learning, providing a level of involvement and visibility that was simply not there before. So, parents are far more aware of their children's learning needs and gaps. In terms of or extracurricular learning, the propensity to consume these services is even higher than tutoring, with many parents seeking interest and skills-led learning that simply isn't provided in the traditional school environment. This market segment is large, immature, and highly fragmented. Therefore, the opportunity to scale our or extracurricular learning service with the right course portfolio is significant. For us, the optimal teaching and learning model is far more than just about matching a student with a tutor. For great teaching and learning to occur, you need 4 key elements. Firstly, a comprehensive learning plan with all the content in digital format mapped to the curriculum. Secondly, you need to match the student with the right tutor, someone who's highly cognate in the discipline and a great communicator who guides the student through their learning plan fully synchronously and online. Thirdly, To reinforce the concepts that have been learned, you need to provide targeted practice between learning sessions. Finally, you need to measure every learning interaction to optimize the learning experience, analyzing exactly what the student knows and what the student doesn't know, and then use this data to deliver detailed reporting and feedback and recalibrate the learning program. And all the quality assurance is data-driven. All tutor matching is algorithmically determined. All learning progress has data at its core, and all processes and workflows are fully automated. And this is what enables us to deliver high-quality, personalized learning at scale. Cluey has experienced significant growth with strong and improving unit economics. The chart on the left illustrates the growth in revenue. Cluey achieved revenues of 34.3 million in FY22. That's an increase of 116% on FY21 and a compound annual growth rate of 236% since FY19. The chart on the right demonstrates how we've been able to significantly reduce one of our key cost elements, namely variable customer acquisition costs, or what we call CAC. CAC is the customer acquisition cost to acquire a new student. And this includes digital media spend, brand spend, and the cost of our sales team. In FY22, CAC per new student reduced by 24% on FY21 to $429, whilst at the same time, we doubled the number of new students. What's really encouraging for us is that the Cluey Group lifetime value to CAC ratio improved by 33% in FY22 to 2.8 times. So what this means is that on average, for every dollar we invest in acquiring a new customer today, we generate $2.80 in revenues after accounting for the cost of acquiring the student and the tutoring or teaching cost associated with delivering the service. So, on average, each student adds more to revenues than to costs. And as we continue to scale the business, we move closer and closer to profitability. Looking forward in FY23, our focus is all about balancing the key priorities of continued growth, improving unit economics, and driving towards profitability. And we have 6 pillars that will help us achieve this. Firstly, we'll continue to invest in sales and marketing. We believe there's still plenty of room to extract greater efficiency out of our sales and marketing initiatives that will result in a lower CAC. And we'll continue to invest in product and technology. And this has 2 key benefits. From a learning perspective, we're able to further optimize the learner, parent, and educator experiences. And by continuing to invest in product and tech, we're also able to deliver further automation in the form of self-help and self-service configuration. This means parents, students, and tutors are increasingly able to manage their service directly online using the student and tutor portals. In essence, this means we can continue to scale our business with less reliance on staffing or resource increases. And this all plays into improving unit economics and improving margin. For some time now, we've been speaking about the opportunities for geographic expansion. We're still at the very early stages of our rollout into New Zealand and still see a lot of room for growth in this market. And CodeCamp recently launched a successful pilot for after-school programs in the UK, and we're now looking to expand this business and scale. So whilst Cluey is almost entirely a B2C service, CodeCamp operates its holiday camps and after-school programs at schools. In other words, it's a B2B2B service or B2B2C service. In FY23, we're planning on significantly increasing the number of schools offering CodeCamp programs, scaling their enrollments through further investment in sales and marketing, as well as launching new programs. And a really interesting opportunity also exists for them to now incorporate Cluey Maths and English learning programs and tutoring as part of their after-school offering. We're currently piloting this. Whilst product and tech investment is critical as a driver of cost reduction, it's also important in that it's a key enabler of driving improvements in the student and tutor experience, and ultimately this supports lower churn and increased LTV. Finally, onto M&A. We know that different students or parents look for different learning or education services at different points in their learning journey. Tutoring and test preparation is one, after school and holiday camps is another, but there are many more. That's why we continue to consider a range of M&A and partnership opportunities.
Well, hello, I'm Mike Winlow, Managing Director and CEO of Emerging. We're a clinical stage biotech developing new medications for patients with unmet needs focused on neuroscience and mental health. And I'm really excited to tell you a little bit about our programs today and why I think we're such an exciting investment. So Myriad is focused on neuroscience and mental health, and we have two platforms that we're developing to address issues in those domains. The first is an ultra-pure cannabinoid delivery platform. We're using ultra-pure cannabinoids. We have created an advanced delivery formulation. We have a number of products that take advantage of that formulation. And our first and leading program, EMD-RX5, is already in phase 3 clinical trials, pursuing a number of global registration opportunities. And we have other programs coming up behind. We also have a substantial preclinical R&D pipeline powered by MDMA-inspired drug discovery, where we're taking MDMA, otherwise known as ecstasy, as our source of inspiration, and we're making changes to that molecule to develop new treatments to address a range of unmet needs in neuroscience and mental health. What gives us an edge in both of these programs is that we have carefully studied the clinical effects of cannabinoids in real patients through our clinical service subsidiary, Emerald Clinics. We operate a number of clinics around Australia. We operate a telehealth service, and for 3 years, we've been treating patients with cannabinoid medicines for a range of unmet needs. But we've also been collecting really high quality clinical evidence with those patients to understand what's working and what's not in which patients. And we're taking those insights and they're helping us develop our formulations and pick indications to which we can pursue registration opportunities. We also have a really unique MDMA library, one of the world's largest and most exclusive and unique set of compounds related to MDMA that we have developed in partnership with clinical and medicinal chemistry experts at the University of Western Australia. And finally, we have a tremendous team of biopharma executives who have had successes registering FDA-approved drugs and other successes around the world, helping guide and inform our team on this journey. Of course, we have a really strong IP library backing that up and some terrific support from key investors, including 10 Mile, and we're part of Andrew Forrest's first cohort of funds, or companies, I should say, backed by his healthcare-focused investment fund. So let's talk about our cannabinoid program and why we think it's really unique and why we think it's set for really terrific success. We've focused on ultra-pure cannabinoids. The trouble with cannabinoids is, although they're incredibly promising as medical treatments for a range of conditions with a very well-established safety profile, most cannabinoids typically have variable purity in that they come from a plant, and it's very hard to control what you're actually getting in your cannabinoid medicine. And so purity is a concern. The other concern is most of the cannabinoids today come as oils, which can spill. You have to give them through droppers or gel caps, and there can be batch-to-batch variation in those dose forms as well. The other thing we know, having studied cannabinoids closely, is the bioavailability, that is how much drug is actually delivered to the bloodstream, can be very, very low. It is noted as low as 6.5%. So of all that cost in buying these medications, and when you take one of these medications orally, you're only getting about 6.5% delivered to the bloodstream where it can actually do work. So there are two major problems with the dose forms alone. The other big challenge with cannabinoids is that there isn't really great evidence for where they should work most effectively and for which patients. Most of the research is often conflates recreational cannabis use, and there have been to date very few formal randomized control trials helping inform where these cannabinoid treatments work most effectively. So we have these two challenges: getting better dose forms and getting better evidence. Now, what we know, though, is that some medications that have achieved registration, in fact, there's only been one in the world to date, and that's GW Pharma's Epidiolex CBD medication, which was approved in 2018 for seizure disorders. It stands alone as the only example of a registered CBD medication that's made it through formal regulatory pathways. It took that company, GW, 20 years of clinical development, nearly $2 billion of investment, but they were rewarded for that effort by being the first registered medication. And that company, GW Pharma, was acquired by Jazz Pharmaceuticals in February last year for $7.2 billion US. So with that as the shining example, we know that the formally registered, highly pure cannabinoids that are backed by evidence have tremendous commercial potential, and that's what we're focused on developing. But we want to be better than the incumbents, which is why we invested in a CBD delivery platform, which we call EMD-RX. And our first dose form using that technology, EMD-RX5, is already at phase 3 clinical studies. And we were able to show using this dose form that we take highly purified, ultra pure CBD, developed in a lab, not grown out in the field where things can affect quality and can create variation in the medication. So our ultra pure CBD has the kind of purity profile that the FDA and major regulators in Europe require. We're able to develop unique delivery technology to improve the bioavailability of this medication as well. That is, how much actually gets delivered to the bloodstream where it can do work. And we're able to show that we're able to meet the delivery of Epidiolex, but have lower variation, have excellent safety and tolerability, and actually have higher doses delivered in the hours between 3 to 8 when you want your medication to be effective, allowing once to twice daily dosing. So with these advantages, really proudly now taking this drug forward into a number of registration opportunities. As I mentioned earlier, we are already at phase 3 studies, and we are pursuing our first TGA approval for over-the-counter treatment of the symptoms of psychological distress. This is a condition that affects 15% of the adult population. It's the symptoms of anxiety, stress that can affect people. It's more prevalent with patients with chronic diseases. It can lead to sleep disturbance, GI upset, and a range of other unpleasant symptoms. And we believe we can address those symptoms with a low-dose CBD backed by evidence and delivered with our technology. So our first effort is to achieve a registration in Australia for over-the-counter use of this medication. But because we've focused on the purity and the technology, we think we can take our medication, that same dose form, to other global markets which have very strict regulatory controls, like Europe, like the FDA. Because of our real-world data, we can also take that same dose form into other indications, and therefore expand the market reach and the potential of our dose form, both by growing the geography of where we can use those medications, but also the clinical use of those medications as well. And what's really exciting about the RX platform is that we're also developing additional dose forms with even better bioavailability and pursuing more serious clinical indications with that, and looking at combination treatments as well. So it's really a terrific platform that's got a huge potential and a lot of opportunity. It is also starting to catch the attention of major pharma, and we're in some early commercial conversations with various development partners on using this technology as well. So that's our cannabinoid program. It's the most advanced, and as I mentioned, it's a clinical stage, phase 3 trials pursuing first registration in Australia. Coming up behind that program is our MDMA-inspired drug discovery program, which we're working closely with the University of Western Australia to develop. This program is really exciting. We take that core molecule, MDMA, otherwise known as ecstasy. Yes, it's the party drug. It's the drug that's currently illegal, but it has some really unique properties which make it a really intriguing and fascinating compound to work with. And it's a drug that's starting to get a lot more attention and show promise as a psychedelic-assisted therapy for major mental health disorders like post-traumatic stress disorder. So what MDMA does quite uniquely is it dramatically raises the release of 3 primary neurotransmitters. That is serotonin, which contributes to feelings of well-being, dopamine, which contributes to feelings of pleasure and satisfaction, and noradrenaline, which is involved in the fight or flight response and involved in activation and alertness. And so MDMA uniquely creates this alertness and positive mood and very strong pro-social effects, that is intense feelings of compassion and connectedness to other people, that make it a very useful therapy in an adjunct to psychotherapy, a very useful medication, I should say, as an adjunct to psychotherapy for the treatment of really serious and difficult to treat mental health disorders like post-traumatic stress disorder. And MDMA is starting to show tremendous results in phase 3 trials for really difficult to treat post-traumatic stress disorder. However, because of these qualities of euphoria and alertness and the amphetamine effect, we also recognize that it would be preferable if we could control or regulate the extent to which the euphoria and the amphetamine effect play out. And so this as a compound becomes a really interesting technical question. Can we adjust this molecule to actually improve its clinical utility, its safety, and maybe its versatility as well? So we're working with UWA, and we have what we believe is probably the world's largest library of unique MDMA-inspired compounds. MDMA is a great drug to work with because it's small, penetrates the brain, it has many points of diversification which allow us to change and adjust this molecule in many ways. We know, as I described, that MDMA hits many brain targets, and so there's an opportunity to tune selectivity and create different clinical effects. And so we are really excited to be working with this compound and its potential, and are now at a stage where we've generated more than 140 unique MDMA analogs. We've taken most of those through comprehensive safety screening program and validated that many of them passed the safety screens. We are taking the most interesting compounds from that safety screen work into preclinical studies as well. And now we're starting to differentiate and group our compounds into 3 main categories where we think we're going to have some therapeutic successes, or where we hope to have therapeutic success. And that is as a next generation MDMA-like molecule for adjunct therapy for major mental health disorders, where we might have a faster acting MDMA, for example, or a more potent MDMA to help treat those conditions. We also see potential to treat a range of neuropsychiatric conditions like Parkinson's disease, where selective activity on dopamine might be preferable. And we're also seeing some potential with non-neurological benefits as well, given some of the things we're learning about this compound. So it's a tremendously rich and diverse program that's already showing some really great promise from our early screens. And over the next 12 months, we'll be reading out some of that preclinical work. Which really brings me to a summary of our program here. We have achieved a lot in 12 months, and there's a lot lying ahead of us. We have 10 Mile on the clinical register. We have an amazing biopharma executive in Dr. Karen Smith, who has joined our board. She's the ex-chief medical officer and head of global research and development at Jazz Pharmaceuticals, the company that acquired GW last year. And we also have a terrific data platform, which continues to grow and evolve. On our RX5, we're now into those phase 3s. And so in the next 12 months, we expect to conclude the phase 3 study, submit the package for TGA review, and obtain TGA approval for an over-the-counter medication for our indication next year. In parallel, we also expect to launch and initiate a number of commercial partnerships to help take that RX5 platform across Australia and around the world. Coming up behind that on our cannabinoid program is RX7, which is developed for prescription indications. That program will advance to phase 1 and will launch a US-focused clinical approval strategy for RX7 as well. And on the MDMA front, continuous creation and synthesis is ongoing. So we'll generate more analogs informed by the screening program. We've already launched a preclinical program using a number of global partners. And I expect in the next 12 months, we'll get lots of readouts from those preclinical activities, allowing us to identify a number of really promising leads, which we then will prepare for proof of concept animal studies as a first step towards phase 1 clinical trials. And so that kind of wraps up the exciting kind of update for Emyria. I really encourage you to follow us along, and I want to thank you for your time and interest in our company.
Yes, good morning. Look, my name is Simon Lill. I am chairman of NIMI Resources Limited, amongst other activities. NIMI is a new listing on the ASX. We listed back in November of 2021. We've been quite active in an exploration sense since then. We are pursuing nickel in what we are describing as a new nickel sulfide district. We've had a lot of very good background information to date on the potential for nickel to be discovered in this region, and we will go through that over the next few slides. If we flick through, so there is a standard disclaimer, and you can read that in your at your leisure. But if we go to the main investment summary, you can see that we have a large land holding 2,500 square kilometres or thereabouts. We're in the Yilgarn Craton. We're calling it the Karoon Hill Belt. You can see it's running fairly parallel to the Kambolda Belt. And the belt, our tenement area, is to the north of the Forrestania Belt on the same geological structure as Forrestania to the south and you and me to the north, up near Mount Magnet there. So we have good progeny in that sense. So we're claiming it's the northern extension of the Forrestania Belt, and as you can see, it's some 370 kilometres to the northeast of Perth. Now, the project has been put together by one of my directorial colleagues, Luke Hampson, and he has focused a lot on his original tenement package. So he's identified over 30 targets in 6 zones. The reality is we're going to have a lot more targets because we have added to that package over the last 12 months. I think it was originally about 500 square kilometres, and as you can see now, we're at 2,500 square kilometres. There is always an argument, of course, that there's not a lot of point adding a whole lot of tenements if they're moose pastures, but we have followed structures along the lines and have particularly grabbed some of the tenements that we have for particular reasons, and we're now receiving some approaches from joint venture purposes, and there are some other tenements being picked up in the region. So the significant pipeline of targets, 30 targets in 6 zones, there is a certain level of historical in that. There will be plenty more targets once we actually start doing the early work on some of the targets. We're quite comfortable in the area that we have obtained. I always tell the story that I recall a metallurgical friend of mine saying, Simon, if it's underexplored, there's no mineralisation there. And what he is suggesting in that sense is that the old timers would have found it if there was anything worth finding. Well, since we've been involved there, we have uncovered that we're on Greenstone Belt, the mafic ultramafic sequences of Greenstone Belt. We're in the Yilgarn Craton. So the same age rocks as what we might see out in the Kambolda Belt. We've discovered a gossan, and I'll talk a bit more about gossans in a little while, but there are all the hallmarks of this being a mineralised belt. We just need to find the areas of mineralisation, and I always use the reason that my background, I'm chairman of De Grey Mining. De Grey has one of the world's largest gold discoveries up in the Pilbara. We're not here to talk about De Grey, but the point being that at the time and prior to the discovery, we used to run into every broker in town would say, you won't find any gold up in the Pilbara. There's no gold in the Pilbara. And we have proven that, demonstrably have proven that incorrect. Shortly after our key discovery, Chalice discovered Julimar, closer to Perth, in an area that people would not have thought was going to find mineralisation either. And that has been a major discovery. And then Western Australia has also been blessed with the Irahidi lead zinc discovery in an area that people may not have expected to have found that sort of mineralisation as well. So WA in the last 3 years has had 3 major discoveries in regions where there's been plenty of time for the old timers to pick over them, and plenty of naysayers about them. So we can see no real reason. In fact, we'd be surprised if there was not a discovery of some significance in our project area. I will say we are targeting nickel. That does not mean that we'll come across other commodities. We're saying it's a nickel copper province, but we have seen obviously indications of gold, given that we're south of the U&Me mine. There is potential for lithium that we've identified on the project. We have in our tenement package, there's a little square to the west which we have picked up, which is appears to be a carbonatite, and the famous carbonatite in Western Australia is Mount Weld. So potential for rare earths and other metals within that carbonatite once we start looking there as well. So we are looking for nickel, but we'd be surprised if we don't find something else. The types of nickel we are looking for, look, everyone's after the higher grade massive sulfide mineralization. We're looking at it and saying, well, really, there's 3 different types that can work for us. We have the high-grade massive sulfide, which is what most of the market looks for, and rightly so. Grade will be king. It's a bit harder to find, and of course, it often happens at depth as well. So we're looking for that, and this slide 2 on my presentation here is showing that we've recently drilled into a gossan that we discovered when we were actually preparing a sump for another drilling program. And gossans are synonymous with nickel discoveries, actually, that the original Cambolda nickel discovery of the Poseidon boom wasn't discovered by gossan, but once they had discovered the nickel and looking around, they found that there were a lot of gossans in the region. Similarly, Forrestania was discovered by finding gossans as well. Not every gossan contains nickel, but if there are gossans in the vicinity, it is seen as positive. What we've seen here is the gossan that we drilled, and we've only recently reported these results, does show elevated nickel results from the results that we have previously been reporting. Now, I'm not pretending that the 0.48% itself of nickel that was in that gossan was only 1 metre. That's not an economic mine, but it is an elevated level from the background nickel mineralisation that we have been reporting. So what we're very keen to do is to follow that gossan down, because this rock, it's quite shallow where we have intersected this. So it will be weathered, which will mean that the nickel has been leached out. But it is showing that we're carrying nickel, copper, cobalt in this gossan. Beyond the gossan, and you can see the results there, 6 metres at 0.31%, 4 metres at 0.3%. Beyond the gossan, we get back into the mafic, ultramafic sequences, and we have a further 226 metres at 0.16% nickel. Now, we don't get excited about 0.16%, we understand that, but it does show that we have, and consistently we've shown this sort of size, intersection, and mineralisation across the various zones that we have been drilling. Large, lower grade nickel intersections, very consistent nickel intersections. Often with these nickel intersections too, we are getting high MgO, which is a very strong indicator of komatiite material. So the 3 types of nickel that we could be chasing, the high-grade massive sulfides, which we hope that as we follow the gossan through, that we'll come across some of that material. The komatiite material is similar to what BHP these days, previously Western Mining, are mining at Mount Keith. Now, they've been mining that for some 40 years or so. I understand the rough average grade there is about 0.6%. So komatiites are sort of a lower grade, wider spread material, and they can be very, very economic, as Mount Keith, Yakabindi have shown in the northeastern goldfields of Western Australia. And then, of course, the lower grade nickel. Now, I don't pretend that 0.16% is likely to be economic, but there is a lot of information coming out of Canada, probably mainly, where they are doing feasibility study work on these sorts of grades of nickel, maybe a little bit higher at 0.2%. And I would make the point that in the gold world, where I have a little bit of experience now, the largest Australian gold mine, which is Boddington, is operating at 0.4 grams per tonne. 30 years ago, you would have looked at anything under perhaps 2 grams per tonne. So look at what the story is that we are exploring a very large nickel sulfide system. We have shown consistently that this area is fertile for nickel sulfides. There's a lot of large intersections. Now you can see a couple on this slide here. 363 metres at 0.14% nickel, 4 metres at 0.14% nickel. We've just discussed the economic potential of that. But what it does show is there's a really strong background of fertile nickel sulfides. The secret for us is to find where those nickel sulfides have accumulated, where the concentration of them has increased, and where we can get the higher grades that improve the economics. But these sort of results that you can see at Godley have been very, very consistent across a lot of our drilling programs. The second bullet point up there, we did some RC holes prior to the IPO. We encountered significant mineralisation across 16 of those, similar sorts of depths. I mean, they're RCs, they're not going down as deep as these diamond holes that you can see at Godley, but you're still getting the 200 metres at over 0.1% nickel, with indications on the way through of copper, cobalt, etc. So again, a very, very strong background in nickel sulfides. DEACE is the other project that we have been concentrating on. Again, you can see those results there. We've drilled a very deep hole looking for the bedrock, which we didn't find after 871 metres. We were going through a couple of moving loop plates that we had found. So we're still waiting on those assays. But again, look, we're seeing that nickel mineralisation was extensive from 384 metres to end of hole. So there's another, whatever that is, 500 metres of probably similar material to that which we've reported at Godley. So that's still to come, the DEACE the DEACE prospect results there. Moving on to the last slide. Look, the takeaways are we have a large 100% approved tenement package with all heritage agreements in place. A lot of the other exploration peers might be joint ventured or have smaller areas, etc. This is a large area that can be both a positive and a negative. I accept that. But as I say, we are fielding some interest in joint ventures into the area as well, while we focus on zone A, B that you can see in the middle there. We're doing ongoing geophysics across the project, including recently downhole electromagnetic surveys, etc. They're all to be reported. We have shown that we have greenstone belt, that we have komatiites, which is a komatiite flow is a lava flow effectively, which is fertile for nickel sulfides. We've got multiple exploration zones, multiple commodity indications. You can see the carbonatite there that I mentioned earlier in zone F that we've indicated as a little circle there on that square. So we've got some broad scale regional exploration underway that's been undertaken by our key geologist, Fergus Jockle, who's a very experienced exploration geologist. And one of the things I always like saying, whether it's this company or another company, Fergus loves getting his hands dirty. He's not just sitting in the office looking at screens. He loves getting up to site, getting out there and doing the logging of the core, etc., etc. And he's been around the game for a while, and yet he still loves that. So he's a geologist with a love of geology, which is not always the case, actually. So he's very confident, very excited about the gossans that we have, as have been some of the shareholders that we have, who are perhaps a bit more experienced in the nickel world. And the fact that we have gossans is seen as a very, very strong positive for them. So look, it's an underexplored new greenstone belt. The difficulties for the management of that is that we're a junior company as well, but we're aware there's quite a few eyes on us at the moment too, and we are starting to feel as though we're understanding what we have a lot better, and that we'll be able to start targeting our drilling a lot better in the next drill program, which we would hope to commence. Where are we now? October, sometime during November. We still have the problem in the exploration industry in Australia and Western Australia that assay results are still delayed. So results from the next program probably not out until the new year. But look, that's about all at the moment with the time that I was given for this presentation. And there are the details at the bottom slide. And if you feel that you wish to contact us and ask any further questions, there's an email address there, and the team will happily look after you. So thank you very much for your time.
Yes, good morning, and thanks for making the opportunity available, Capital Network, to myself. My name is Richard Brescianini. I'm an executive director of Heavy Rare Earths Limited. We're a newly formed company that listed on the Australian Securities Exchange on the 24th of August. So we're recent. This particular slide shows our capital structure, and under the banner of corporate snapshot, you can see we've got 68 million shares on issue. Our market cap is a very modest $11.6 million as at yesterday's share price of 17 cents, with an enterprise value of $5.6 million on the basis that we raised $6 million at IPO. What are we all about? Well, we're all about rare earths, as our name would suggest. Rare earths are used in the manufacture of rare earth permanent magnets, and we see currently ongoing supply side issues and forecast demand side strength in both e-mobility, that is electric cars, hybrid and battery electric cars, and wind power, which contains rare earth permanent magnets in the wind power generators. Both of those supply side issues and forecast demand side strength will support a resilient rare earth price environment for some time to come. We've assembled a strong team. Myself as an executive director, I have about 14 years experience in rare earths and 35 years experience in exploration and mining. We have John Byrne, our non-executive chairman, who's very well known in capital markets and is a person very closely aligned to my thinking in that we want to get things developed. And finally, we have Ryan Skeen, our non-executive director, who's very skilled in financial circles as well as in networking. Our key project is in the Esperance Norseman region of Western Australia. It's called Caolinia, and I'll go on to explain exactly what we're doing there. This next slide shows the location of our project. As I mentioned, it's in about halfway between Norseman and Esperance, about 40 kilometres off the highway. It's on a 230 square kilometre granted exploration licence. HRE owns 100% of the mineral rights on the licence. The company, prior to listing, drilled its maiden inferred mineral resource of 28 million tonnes of 625 parts per million total rare earths. Of that rare earth cohort, 25% is in the valuable magnet rare earths. They are neodymium, praseodymium, terbium, and dysprosium. And 23% of the rare earth mix is the strategic heavy rare earths. The deposit averages 8 to 9 metres thick, is shallow, flat-lying and open in all lateral directions, and is hosted in a clay-rich horizon that is similar in style to deposits in southern China, which are currently the world's main supply source of heavy rare earths. So there is some risk in China remaining almost the sole source of heavy rare earths from the globe. The area of our tenement that we've drilled to date represents less than 1.5% of the total area of the tenement, and that was to deliver 28 million tonnes of resource. And we've also completed some first-pass acid leach metallurgical test work on kaolinium mineralisation, and that has delivered encouraging results in acid leach test work. This slide tells you exactly what we're intending to do in the next 12 months. The picture on the screen shows the location of our tenement. The black dots show the location of proposed drilling, and the pink dots show the location of drilling that was undertaken in 2021 to deliver 28 million tonnes of rare earth resources. The company has commenced during mid-September a resource expansion drilling program of up to 10,000 metres in 330 shallow air core holes, which is initially focused in the southeastern part of the tenement. You'll see the grid down to the southeast of the southern part of the resource. We've also commenced an expanded metallurgical program of acid leach and other site of test work with Strategic Metallurgy here in Perth. Those samples or large composites are already sitting with the lab, and they've commenced their test work. No results have been delivered to date. Our aim is to establish two things in the program over the next 12 months, and that is to establish a resource inventory and also a corresponding metallurgical process that can support the potential development of a long-lived rare earth operation. That's the bottom line. You'll have to deliver quite large resources considering the modest rare earth grades in the ground, and you'll have to deliver a metallurgical flow sheet that can recover rare earths with such efficiency that you can make a reasonable margin in the sale of rare earths. So that's really our aim over the next 12 months, and we've just commenced that journey. In addition to our resource expansion drilling program, you can see on the map that we have some regional drilling traverses also planned, which are meant to generate new target areas for ongoing resource expansion work. That's it from me at this point in time. Once again, I really appreciate the Capital Network's opportunity to present here today, and watch a little bit more of what we do on our website and other platforms. Thank you very much.
Hi everyone, thanks for listening today. My name is Fleeta and I'm the CEO of Little Green Pharma, Australia's trailblazer and first producer of cannabis medicines. Little Green Pharma is creating a world of difference through transforming the lives of patients globally, and our purpose is to solve real patient problems. We operate a vertically integrated medicinal cannabis business model. This means we not only grow our own cannabis plants, but we also manufacture them into final medicines for our patients. We have two large strategically located cannabis facilities, one right here in Australia and one in Europe in Denmark. We are evidence and research based, making LGP the most trusted brand in Australia. Currently, we are undertaking a number of research projects, with one pain study recently published in a peer-reviewed journal showing that we're on the right track with our cannabis medicine portfolio. We are also sponsoring the Quest initiative. This is perhaps the world's largest longitudinal study using medicinal cannabis for many chronic illnesses, with very impressive results so far. Being across the supply chain is really advantageous, as we can see where the opportunities lie and, of course, where value can be created. LGP has a very clear strategy to achieve our vision. First of all, patient acquisition in Australia. We estimate we have about 20% market share right here in Australia. This gives us immediate cash flow and is solid demonstration of market validity for new and emerging markets overseas. The second is commercial sales volumes in overseas markets. This is where we aim to make the profits. We have a laser focus on Europe, and we're one of the best strategically positioned companies in the world, set to dominate the European medicinal cannabis market. I'll go into more detail in a moment, but LGP is already selling or has a strong foothold in 9 European countries. The third, which is our end game, is unique drug delivery technologies. And this is what will solve real patient problems in the future. Here, we have a number of ongoing R&D projects examining protectable drug delivery methods, but these take time. Since producing Australia's first cannabis medicines for patients in 2018, LGP has enjoyed year-on-year growth. In financial year 2021, revenue grew to $7 million. Fast forward 1 year to FY22, revenue doubled to nearly $15 million. Most of this revenue has been from Australia, but you'll start to see this shift to European sales being more dominant. So Australia is proof of concept, and now we're ready to take on Europe. So how will we make more money? Well, something big is happening in Europe. LGP is right there, and we're already delivering into it. We are extremely strategically positioned. In fact, our supply pathways in Europe can potentially access 380 million people. That's about 75% of EU and UK citizens, excluding Russia. I just want to hone in on 3 exciting new markets there. The first one is Germany, 83 million people. Currently, the medicinal cannabis market is worth approximately 270 million euro. LGP has sales agreements of more than 37 million over the next 3 years with some of the biggest distributors in Germany. And we're on track to target 10 to 15% of the German market. As for Blue Sky, the German adult use market is anticipated to be legalized in 2024, with an estimated 350 tonnes of cannabis flower needed in the first year alone. And this could be worth more than 3.5 billion euro. Not only is LGP situated just 2 hours across the German border, LGP Denmark has a capacity of 30 tonnes of biomass. Let's look at France. 67 million people. Currently, LGP is leading the way in a government-led medicinal cannabis trial, scheduled to finish next year. Although LGP is one of only 4 primary suppliers, we're actually the largest provider and will have sent more than 65,000 units to France. Medicinal cannabis legislation is expected to catalyse soon after the trial has finished. So what does this mean for Little Green Pharma? LGP is in prime position to capitalise on its brand equity and first mover advantage. And most importantly, the government is expected to subsidise existing patients on the trial. And this could be worth up to 10 million euro for LGP. And all of this is in a country with extremely high barriers to entry, much stricter than Australia and even Germany. The third is Italy. 60 million people. Currently, Italian government tenders are the sole pathway into Italy for flower, with only 2 companies successful to date, LGP included. In February this year, LGP won and supplied the government with flower from its Danish facility, worth about $300,000. Although the dollar value was not that material, LGP has just submitted for a new tender worth $3 to $4 million. What this means for Little Green Pharma is LGP is set to capitalise on its brand equity and first mover advantage in the country. And like France, Italy has a very high barrier to entry, with only EU-produced medicines accepted at this time. So that is how we're going to make money. We have all our ducks in a row, and we're ready to deliver large volumes across Europe. We have the capacity and distribution pathways to execute, and it's already happening. We've got first mover advantage. We've got EU GMP recognised facility, and this is a must for selling into Europe. We have the capacity, the people, and the runs on the board. Finally, we're different from our peers. We're the most trusted medicinal cannabis brand in Australia, and it's now being extended to Europe. We're evidence-based, doctors love us, and our research shows we're on the right track. And finally, we have undeniable international positioning. We have feet on the ground, and we're already distributing into our sales agreements abroad. That's it. Thank you so much for your time today. These are my details on the screen. Please connect with me. I'd love to hear from you.
Brickworks can trace its history back to 1908, when our heritage business, Austral Bricks, was incorporated in Sydney. In 1962, the company was listed on the stock exchange as Brickworks Limited. Today, we have a market capitalization of around $3.4 billion, and our company has evolved to include a diversified portfolio of attractive businesses, consisting of a 26% stake in Washington H. Soul Pattinson, an ASX 100 company with a market capitalization of around $10 billion. A significant property division, including 2 joint venture property trusts with Goodman Group, and a substantial building products business in Australia and North America. At the end of the 2022 financial year, the total inferred asset backing of our portfolio of assets was around $5 billion. This includes the market value of our stake in Washington H. Soul Pattinson, our share of net property trust assets, the net tangible assets held within our building products operations, and the market value of selected parcels of surplus development land, partially offset by net debt of $493 million. On a per share basis, the asset backing equates to over $33 per share, providing solid support for our current share price. We believe the company is well positioned for long-term growth. In particular, we are investing to meet the growing demand for prime industrial property, and we will continue to support our North American business as it pursues growth opportunities. In addition, we are nearing the end of a major capital investment program within our Australian building products operations, which will strengthen our competitive position in key markets across the country. The company is conservative, with a low gearing level of 15% and a stable board and management team. We have a proven track record over a long period of time. This is demonstrated through our history of value creation and dividend growth. We recently announced another increase in our full-year dividend. As shown, we have now maintained or increased dividends for the past 46 years. We are proud of this long history of dividend growth and the stability it provides to our shareholders. The Brickworks dividend is underpinned by growing rental income from our property trusts and reliable dividends from Washington H. Soul Pattinson. In addition to dividend growth, Brickworks has a strong history of total value creation. Based on the share price at the end of the financial year, the company has delivered shareholder returns of over 12% per annum since the initial investment in Washington H. Soul Pattinson over 54 years ago, incorporating both dividends and share price appreciation. That means that $1,000 invested in Brickworks in 1968 would be worth around $566,000 today. In addition to providing strong financial returns to our shareholders, we are focused on the sustainability of our operations. Our purpose at Brickworks is to make beautiful products that last forever, products that stand the test of time. Our bricks are made from clay and shale that is naturally abundant. They are guaranteed for 100 years, and many installed 100 years ago remain in service today. Their longevity also allows bricks to be recycled and reused, unlike many competing building products. We are on track to meet the sustainability targets within our Build for Living Towards 2025 strategy. Our sustainability report, recently released, provides more information about our targets and the good progress we are making. For example, across our Australian operations, we have achieved a reduction in carbon emissions of 42% since 2006. This is supported by capital investments into modern, fuel-efficient production processes, as well as product redesign, use of recycled material and onboard fuels, and firing our kilns with green fuels such as landfill gas. During the year, we announced a collaboration agreement with DeLorean to investigate the feasibility of developing biogas facilities at our brick plants. This project is focused initially on our new Horsley Park brick plant, following an initial concept study has now progressed to the development stage. Brickworks is also active in the community and has a long-standing partnership with the Children's Cancer Institute, having made direct and indirect contributions of over $4 million since 2002. I'll now touch briefly on our main operating divisions in building products, and then explain the natural fit with our property operations. Building Products Australia has 1,160 employees across Australia and comprises 27 manufacturing sites and more than 140 design studios, displays, and reseller locations. The portfolio includes Austral Bricks, which is Australia's largest clay brick manufacturer with significant market positions in every state. This business produces around 700 million bricks per annum, which is enough to build approximately 70,000 houses. Concrete Products Division comprises Austral Masonry and Southern Cross Cement, and we have Bristol Roofing. Our newest division is Building Products North America. We initially entered this market in 2018 with the acquisition of Glengarry, a leading brick manufacturer in the northeastern region of the United States. Since then, we have completed a further 4 additional acquisitions. We have now established a business of significant scale in North America. Building Products North America now has a market leadership in key states across the Northeast, Midwest, and Mid-Atlantic regions, 950 employees, 9 manufacturing sites, and 26 retail distribution outlets, plus design studios in New York, Philadelphia, and Baltimore. Our brick manufacturing operations typically occupy vast parcels of land on the outskirts of major cities. Over time, as the urban sprawl expands, this land becomes increasingly valuable. As such, our property division was originally established to maximize the value of surplus land assets held by building products. This resulted in the formation of our Industrial Property Trust in joint venture with Goodman Group back in 2006. In more recent times, the value of prime industrial land has increased significantly as a result of the structural shift towards online shopping, which has made distribution and warehousing facilities a critical component of the retail supply chain. The chart on screen shows the net asset value of our property trust's assets, which now total $1.75 billion. This includes a 50% share in our well-established industrial JV trust with Goodman, and a 50.1% interest in our new Brickworks Manufacturing Trust, also with Goodman. This trust was established a few months ago and holds a selection of our operational properties within Building Products Australia. Brickworks also retains 100% interest in over 5,000 hectares of operational and surplus land holdings across Australia and North America. This includes 4 significant land holdings that may be suitable for sale into property trusts over the coming years. Based on independent market valuations, these sites have a combined current as-is value of approximately $800 million and a rezone value of approximately $1.3 billion. One of these sites is Oakdale East Stage 2 at Horsley Park in New South Wales. This site is a good example of the approach we take to maximising value with consideration of both our building products and property interests. The Oakdale Stage 2 site currently consists of a brick plant and associated quarry. To release this land for development, we're well advanced with a new plant investment that will consolidate our brick operations in New South Wales on another nearby site, also at Horsley Park. This nearby site is well suited for brick manufacturing, being appropriately zoned and having limited alternative uses. It also includes significant additional raw material reserves available for mining and land available for stockpiling. The consolidation of this site will allow the release of the valuable land at Oakdale East, which is ideally suited to industrial property development, subject to approvals. Following the completion of the new brick plant within the next 6 months, we expect to sell Oakdale East land into the Industrial JV Trust in financial year 23. This will significantly extend our development pipeline with the trust, driving continued growth of net asset value and rental income. Over its long history, Brickworks has evolved from a New South Wales-based brick manufacturer to a diversified and multinational ASX 200 company with interest in building products, property, and investments. Our strong financial position and diversified portfolio of high-quality assets makes us confident that Brickworks is well placed to meet any future challenges and continue to deliver on strong performance for shareholders in the years ahead. Thank you.
Carl Sealing from Cadence Capital, pleasure to have you here. Can I start by asking what are the biggest emerging trends that will impact the year ahead?
Look, everyone, thanks for your time. And it's a very important time to be asking these questions because we're on our roadshow at the moment explaining to people that there's been a very significant change in trend in the world at the moment. And that is the change in interest rates. We had interest rates falling from 1981 to 2002 roughly, or 2001 roughly. And now we're seeing interest rates going up. And that is a trend that should go for about 40 years if it's consistent with the trend from 1945 to 1981. And these long-term changes in trend are sometimes the most important ones that we see.
And what are your preferred emerging stocks or sectors?
Okay, so following on from the answer from that first question, it becomes important to work in sectors and stocks that can perform well in periods of rising interest rates. So let's just reflect on the period we had where interest rates were falling from 14% in America and 17% in Australia to about 2% in Australia and 0% in America. During that period, you could buy any asset really. And as interest rates fell, your repayments on interest were lower and the asset went up in value because the asset is an inverted, it's priced on the inversion of the interest rates. So really, in those days, I'd jokingly say what you did was you bought the dip. Whenever any asset fell slightly in value, you just bought it and it recovered again. We're in a completely different environment to that now. So now we're in an interest rate rising environment. Assets on average will really struggle. When interest rates go up, bond prices go down, house and property prices go down, and PEs, free cash flow, etc., valuation metrics for stocks go down as well. So you're then stuck trying to find those ones that benefit from rising interest rates, companies that have pricing power. These companies with pricing power are the things that you need, not the things that you want to buy, not discretionary items, but the things that you need, like energy, petrol for your car or any fuel or electricity, gas, food, and any of these items of necessity become expensive because the price of them goes up and you still have to buy them. Because the price of everything's going up, but you first of all take care of the things that you have to buy before you do any discretionary spending. And that's a very big change compared to what we've experienced historically.
So what emerging trends should everyone learn more about and why?
Okay, so I've been going around on the roadshow saying what you need to do is have a look at this interest rate chart that we have on our website over the last 220 years. And then we've adapted that interest rate chart to show what interest rates might look like in 25 years' time. The average interest rate over the last 220 years is 8.5%. They got as high in America as 14% and as low as 0%. And in Australia, they got as high as 17% and they got as low as around 1.5 to 2%. So what you need to do is look at that period from 1945 to 1981. I think I said that in the first question, where interest rates were going up, and really study that period in detail. That's a period that if you reflected on it, you would find inflation, you would find rising energy prices, you would find rising cost of food and protein, you would find skirmishes and what we call small wars, not a major world war, small wars to capture territories where you could capture energy resources and the scarce resources that are available on the earth. You'd be wanting those. And then you might have something like someone trying to corner the silver market, like happened in 1976, to try and manipulate the US dollar. That didn't succeed. And then towards the end of that interest rate rising period, you had a massive surge in gold price as everyone thought, okay, these very high interest rates, nothing retains its value. So we have to try and buy something like gold. Now, imagine that world, a world where you have skirmishes over territory, rising petrol prices, rising energy prices, rising gas, electricity, inflation in the system. You don't have to imagine it. It's already started happening. So we're in that world already. So there should be nothing really unique about telling that story, although it's not popular to tell people that interest rates are going to go up. Obviously, everyone, almost everyone, is biased towards buying an asset, borrowing money to buy it, and then wanting it to go up in value and hoping that the interest payments don't go up. I mean, politicians are not going to say it's great that interest rates go up. Your bank manager's not going to say it's great. That your employer, your employee, no one's going to think it's great that interest rates are going up. They just are.
Well, good morning, everyone. Thank you for joining us. And let me give you a brief introduction to PET, or FOSLOT Environmental Technologies. We're in water remediation around the world, and our aim is to return waterways to health. We are an Australian company operating in the water remediation environment for more than 20 years. We have a global footprint of about 22 full-time staff, numerous agents and licensees around the world. We're headquartered in Melbourne, publicly listed on the Australian Securities Exchange under the banner PET. Our flagship product is FOSLOC, originally developed by CSIRO in the 1990s. It binds phosphorus and settles it as a benign compound, environmentally safe in the water body. We've recently added a new product called FOSFlow, which binds phosphorus but in flowing water, which is obviously complementary to FOSLOC. We've been extensively reviewed by our peers with over 100 scientific journals and papers written over the years and published. We have some distinct advantages against some of our competitors, and we've been applied to more than 300 waterways across the world to date. There is a global challenge around nutrient loading in water bodies, particularly lakes, reservoirs, freshwater environmental bodies are big challenges, and phosphorus is one of those elements that causes particular impacts. Most of these impacts are visible via algal blooms, and you can see those in many waterways, and the problem, of course, is getting worse, accelerated by human activity. A number of countries report that phosphorus pollution is the single biggest issue that they must face in their natural and freshwater bodies. Around the world, and I won't go into all the details, but around the world, It is significant in all parts of the world. The US, 71% they talk about of their lakes are impaired. In Europe, up to 83%. There are various frameworks and directives being applied now to lake owners and managers that they must have nutrient levels at certain under certain levels to be compliant. So this is a significant issue, and it's growing. FOSLOC is one of the technologies that works in this to eliminate this problem. It's the flagship product for us. Unique remediation tool, provides strong ecological structure and function to the water bodies. As I mentioned, it was developed by CSIRO in the 1990s. FOSLOC works by binding available phosphorus, rendering it inert, forever bound in a compound that is not released again in that waterway. Extensively researched with many accreditations attached to the product, including drinking water approvals in various countries. It's been applied, as I said, over 300 water bodies around the world, extensively studied with a lot of literature produced on it. The newer product is FOSFlow, which complements FOSLOC as it treats the flowing water, the inflows into the water bodies, and you can see the various applications that can be used. It's unique in that it can be added to the water in a, for want of a better term, a tea bag, obviously a very big tea bag, but it can be removed once the the phosphorus is absorbed onto the pellet. The product is then removed, and uniquely, it can be used as a slow release fertilizer once that product has been removed. So it's a unique product. It complements FOSLOC as now it treats the inflows, while FOSLOC treats the in situ problem of phosphorus. For the company itself, we operate on 4 pillars of the business: customer, manufacturing, R&D, and people. I wanted to just touch on customers and commercial first. You can see we operate in two channels really, which one is the direct to lake market, largely, large lakes, large water bodies where we operate directly with the customer and talk directly with those customers about their needs and about the data requirements and the lake itself. And then we also operate through a distribution channel in most parts of the world where we sell to distribution. They also will talk to large lakes, but also talk to applicators and more of the smaller water bodies, but more repeatable treatments that go on all around the world in various private, municipal, ag, mining, recreational water bodies around the world. So that's fundamentally how we operate commercially. And this is where we're set up around the world. We do have a global operating presence. In Canada, we have a subsidiary working on some registration challenges in Canada, but expect that to be a significant opportunity for us. The US, we have a team there of commercial and sales and marketing people. We have a manufacturing MOU signed for Western Hemisphere manufacture in the US. We expect that the business case to be completed in the next short while to decide whether we go ahead with that or not. We have multiple distribution agreements. We're working with the US Army Corps of Engineers in the US and also the City of Orlando. And we have a number of large lake projects going on as we speak. In Europe, we have our commercial team as well, based in the UK and Germany. Our head of aquatic science is based in Scotland, and we have distribution agreements with many partners throughout Europe. We also have significant large lake treatments pending in Europe and projects we're working on, particularly in the Nordics, Finland and Norway specifically, and then in Germany and the Netherlands. And if you look on our website, you can see some previous treatments late last year in the Netherlands, which were hugely successful. Brazil, we operate under a licensee, have done for many years and very successfully through Brazil. We're just opening up distribution in Uruguay. as well. In China, we've changed our sales model to be more distribution focused rather than direct. And we also manufacture the product in Tianjin, which is just out of Shanghai in China. In New Zealand and Australia, we have our corporate office obviously based in Melbourne. R&D, operations, finance and sales operate out of that office. We're developing new segments throughout Australia, and we have sales agents and applications in New Zealand. In fact, one happening this week at the City of Auckland in New Zealand. For R&D, our additional FosFlow product just recently has been a huge success of the program. We're also now focusing a lot on nitrogen capture, which is the other significant nutrient that causes pollution in lakes, and also the development of and enhancing of the FosLock product itself, as well as some other new segments around dredging, mining, mechanical harvesting, etc. We've recently completed our half-year review and presented to investors on that. So this slide is on our website, and I won't talk specifically to all the points, but there is a lot of activity happening around the world, including projects in Australia completed, in Western Australia, trial work, also China with the resetting of the sales team, a number of projects going on in Europe, particularly in the Netherlands in the second half, in fact, right now, complementing some of the treatments that happened in Scotland and the Nordics earlier in the year. The distribution agreements I've mentioned. We've approval for an application in Uruguay happening and scheduled for the second half of this year, so in the next few months, and developments are underway in Ecuador around a large shrimp producer, which is a new segment, important segment for us. And I've mentioned the US and Canada already. This is a new web page that we're going to launch very soon, hopefully in the next few days, where we're going to describe all the open projects around the world that people can have a look at. You can hover over the map and bring up the details around some of the projects that we're working on. Obviously, there'll be caveats that come with the projects that not all of them will get to completion. However, it'll give our interested people a view of what we're doing around the world. So the outlook for the business, it's going to be somewhat challenging in the short term as we rebuild. I haven't talked a lot about the China business, but we've had some challenges in China, and we're needing to rebuild the business with a broader geographical base, and that's what we've been focusing on. So in the short term, that'll remain challenging for us, but we do see opportunities in many of the markets occurring in this second half, and we'll be reporting on those as they come through. The addition of FosFlow and other R&D developments coming soon will be also quite exciting for the business. Focusing on the sales strategy, executing the sales strategy will be a critical component, as well as embedding the new sales model in China, the regulatory issues in Canada, and also the manufacturing process around the two hemisphere manufacturing plants will keep focuses for us. We are in a good funding position. We're very focused on cash flow, having spent a little bit in the last while addressing some of the issues and setting the business up. Redeploying the resources to best support that sales model that I discussed is obviously key to generate cash. We expect to finish the year at the end of December with about 13 to 14 million cash based on current projections. We are debt free.
Mina Habib here, Executive Director at Power Minerals. Thank you all for tuning in. So today's key focus for us will be to talk about our Salta lithium brine project in Argentina. I want to start off by saying I spent a fair bit of time in Argentina, and I returned with great confidence in the fact that we've got sufficient ground to increase our resource considerably, confidence in that we've got great relationships, and confidence in the growth of our technical team there. We believe as a company, we're in that transition process from a lithium explorer to a lithium developer. So today, I want to go through that development plan and give our shareholders the confidence in what we have planned, but also what that will lead in terms of unlocking value for us all. We've got peers that have transitioned from developers from explorers into developers, and there is no reason for us not to do the same, where there's been an increase, there's been an uptake in technology, and there's been a lot happening. So from Power Minerals' perspective, let's have a look at our core focus, and that's the foundation of what we already have. We have 239,000 tonnes of lithium carbonate equivalent from 2 salars, and with grades up to 313 milligrams a litre. But I want to break it down and focus on each salar and look at the opportunity in terms of expanding that resource and the opportunity of having production at each individual salar, and how that looks like in our overall plan moving forward. The first salar that I want to focus on is the Rincon Salar. And when you look at our peers at the Rincon Salar, we've got our Australian peers, Argosy Minerals, and we've seen their transition and what they've done. So as a company, for us, it's great to look at their flow chart and how they got to that stage. So from our end, we're looking to follow very similar steps. They've got 2,500 hectares at Rincon with grades over 400. We've got currently 1,500 hectares there with grades over the 300 mark. They've obviously gone the traditional evaporation route with a brilliant technology on the back of that, and we're looking to fast track our project by partnering with the only proven DLE technology company that's got 10 operating plants globally, and another 6 in the pipeline. So what that means for us and what that means for our shareholders is we'll most likely have sufficient lithium in Rincon to have an operating plant there. So our next steps will be a PEA study on what we have currently. But I think, you know, it's important to look at the company when they drilled, or Power Minerals, when they drilled previously at Rincon, they drilled to 130 meters. So we've seen peers next to us now being Argentina Lithium Energy. They've announced today that they've got grades over 370 milligrams a litre, and they're going in excess of 300 meters deep. So for us, it means unlocking more value by going back to that salar and drilling deeper. So how much we can increase, that's an important question, but it's going to be crucial to how much we can produce there. But we're very optimistic about having a plant there. And that PEA will really map things out in terms of the numbers. We're talking to Sunresa now because they're testing our lithium brine currently in their plant, and we'll update the market. But hopefully really good news, and that will allow us to move to the next step, which is the final piece of the due diligence, and that's meeting on site so they can assess our ground in person. So that's the Rincon project for us. So we're talking to Sunresa there, and the discussions are how big do you want to go? 2,000 plant, a 5,000 plant, and that plant will produce a lithium concentrate in the form of lithium hydroxide, which what we're seeing in the recent market, it's becoming a product of choice for offtake partners. You don't have to go to that lithium carbonate option, but obviously we're looking at both angles. So moving on to Incowazi. So in Kawasi, we have 2,000 hectares. Our next door neighbor there is Ganfeng. They're currently drilling. And what we can see from their end is there's really good porosity. Porosity and flow rate is crucial to a project's success. So from our angle now, we're looking at drilling 500 meters, so 2 holes, a total of 1,000 meters. And this is going to this should increase our resource considerably. This is ground that is not adding to our current 239,000 tonnes. So it's going to be it's going to play an important role. So hopefully we're going to drill any day now. The drill is in the local town, so we mobilise any day, and we'll get drilling and really unlock the value. So this could change the dynamics of our projects considerably. And when you look at the current numbers, we will most likely have a larger resource than Argosy. So with the current lithium prices and the growing demand, it allows us to really help fill that gap. Spoken to a lot of experts in the lithium industry, and they believe there's going to be a shortage to at least 2030. So what that means for us and our shareholders is that we've got plenty of time to help fill that gap, and we're having discussions with the right offtake partners. So we'll finish at Incoasi and we'll move straight to Pharmaceuticals. But I guess the key thing here is as we drill, we're not wasting time. We've got a PEA on Rincon that will start hopefully in the next week or two. And by the time we finish the Incoasi drilling, the PEA at Rincon will be complete. And by the time we move over to Pharmaceuticals and start drilling there, the PEA for Incoasi will be complete. Because the company conducted a brine blending program, there is an opportunity for us to go down that route. And I guess what we're going to do is we're going to compare the numbers of the PEA of individual salars versus the PEA of the brine blended. And the only way that's going to happen is by drilling at Incoasi, and that's happening now. I hope I'm very clear in the message that we will grow our resource considerably as a result of this untapped opportunity of having great ground next to some of the biggest players in the industry. So I want to move over now to Pharmaceuticals. So Pharmaceuticals, we have 7,000 hectares. We've got and I guess in terms of the location, I want to touch on the infrastructure. So I visited that site in person, and in terms of the infrastructure, it's perfect. You've got railway. We believe, based on our geophysics, there's water, which is crucial for direct lithium extraction, and there's nearby gas lines, which once again is an important component of DLE. So it ticks the boxes in terms of infrastructure, and for us, once again, we've got some ground that's directly on the cellar that hasn't been drilled. So we're waiting on the VS geophysics outcomes. But what we're seeing from all our salars is, from the geophysics, is an opportunity for additional brine. Once again, what that means for us and our shareholders is unlocking considerable value. We've got the right MOU partners in place, and we're having discussions with other large offtake opportunity partners. And it's an exciting time for the company. But what we're seeing and from our peers, and these guys are going to start producing soon. There is no reason why Power Minerals can't transition from an explorer to a developer. So I want to give our shareholders that confidence. I want to give them confidence in our technical ability. We've got 5 geologists currently working on the team that are working closely in assessing all our projects, not only the lithium project, but we are talking to external consultants and experts that have helped our peers get to the development stage, and we're hoping they can do the same with us. So we're just going to continue to increase the technical skill, the credibility, and the project management, because that's the phase that this company will transition to very shortly. Is how are we going to project manage this to become a developer? Thank you for your time. Please reach out, and I'll hand you over to Gary, who's the DLE expert for Sunrisen.
Yes, for the DLE of Sunrisen, that we are able to take out of the lithium from the low concentration brine, and the quality performance for that is and we mean the final product, the purity is the same as the lower grade ones. And for our projects in China, we already have 10 commercial projects. And for the brine that we have, the lowest grade was 50 to 60 ppm for 这个 project for, and we think for over sales brand, and for any brand that having lithium over 70 ppm, it can have very good economic benefits. Yeah.
Yeah, thanks for that, Gary. I guess the one question, I think it's important for our shareholders to understand. So your technology allows the extraction of lower grade products, but that concentrate. How does that concentrate compare to, say, for example, a project that's using evaporation and their ppm is between 500 and 800? So obviously it's a higher grade product, but how does DLE allow that lower grade ppm in terms of the compare to the final product of a higher grade using the traditional evaporation?
Actually, for us, when using the DLE, and one of the DLE key benefits was that by using DLE, actually the final purity of the final product are much better than using the post process. So that even for the lower grade solar, we can get a very high quality, better grade product here. And this process was very proven, and we have been using our process along the for the commercial project we have signed. It's now was 73,000 tons lithium there. So this process are very proven, and for any potential investors, you are feel free to visit our lithium lines that are on the running here.
Thank you for your time.
Well, thank you for having me. I really do appreciate the opportunity to share a bit about Whitehaven Coal. Let me start by noting the disclosure statement here with respect to forward-looking statements. So Whitehaven Coal is an ASX-listed company with a current market cap of around $10 billion. We produce a portfolio of high-quality and energy-intensive coal, which we export to Asia for electricity generation, steel making, and smelting. Our three key markets are Japan, Korea, and Taiwan, and we have a growing market position in Southeast Asia as well. Our operations are in the Gunnedah Basin of New South Wales, where we have 3 open-cut mines and 1 large underground mine. And we have 2 development projects in the pipeline. One is a high-quality coal resource close to our existing operations in New South Wales, and the other is a met coal project in the Bowen Basin in Queensland. We employ a workforce of around 2,500 people, with around 75% of the workforce living in regional New South Wales, close to our existing operations. Our coal is railed from the Gunnedah Basin to the Port of Newcastle, where it's loaded at one of 2 coal terminals for shipping to our customers. Now, generally speaking, our sales mix is around 75 to 80% thermal coal, and the balance is metallurgical coal. However, because of the nature of our met coal, which is a semi-soft coking coal and a PCI product, we are able to move our coals between the 2 markets, which isn't the case for all met coal. In this last quarter, in fact, our sales mix shifted to over 90% thermal coal. Longer term, however, our strategy is to grow our position in metallurgical coal to a more balanced portfolio. Let me talk a bit about the quality of our coal. So Australia produces high calorific value or high CV coal for the export market, and Whitehaven's coal is at the high CV and high quality end of that scale. Our coals are very low in ash, they're very low in sulfur and low in phosphorus also. And these characteristics are sought after by both thermal customers and metallurgical coal customers. Looking at thermal coal, increasingly countries in our region are looking to install high efficiency, low emissions coal-fired power, which is an increasingly critical component of their energy mix. Now, these high efficiency, low emissions or HELE power plants not only provide much needed energy security for our customer countries, but they also help them to meet their decarbonisation goals as they replace higher emitting older style power plants with these more advanced technologies. Now, when Whitehaven's coal is used in Healy generation plants, the level of CO2 emissions significantly decreases when it's compared to lower CV coal in subcritical power plants. Now, you can see on this graph, for example, that the plants we're fueling in Japan emit around 44% less CO2 emissions than Australia's subcritical coal-fired power plants in Victoria. Now, as part of their strategic energy plan, Japan intends to close subcritical power plants by 2030 and build replacement ultra supercritical or USC plants. In fact, Japan has 5 new USC units coming online between 2022 and 24, and Korea will commission 2 new units in 2023. Now, this represents new demand for Whitehaven coal. So looking at the outlook for coal demand more broadly, this graph shows Wood Mackenzie's forecasts, and they're forecasting global demand for thermal seaborne coal to largely remain flat to 2030, but then to taper off through to 2050. However, the market is bifurcated, with advanced economies facing demand decline to 2050 as developing countries, mostly in the Asian markets where we are serving, as they continue to grow. According to Wood Mackenzie, by 2030, nearly 85% of the world's coal-fired generating capacity will be in those emerging and developing economies. And as we look at these forecasts, the amount of supply coming from existing mines falls well short of demand. And that's natural because there's been a lack of supply-side response to address this. But in this context, we know that we will continue to play a very important role helping to provide energy security through an orderly energy transition in the coming decades. Briefly, let me look at the financial results for Whitehaven. So this last financial year, FY22, was a very good year for Whitehaven. We experienced exceptionally strong demand and reported record financial results. Russia's invasion of Ukraine and the subsequent sanctions against Russia has increased demand for our product, but we were already seeing demand outstripping supply as a result of underinvestment in traditional energy sources. Whitehaven achieved an average coal price of $325 Australian per tonne in FY22. Now, this translated to $4.9 billion of revenue, a record EBITDA of $3.1 billion, $2.6 billion of cash generated from operations, and a net profit after tax of $2 billion. And we paid, or we will pay, $1 billion of taxes and royalties in relation to FY22. Now, because of these fantastic results, we fully paid down our senior debt facility and we paid a final fully franked dividend of 40 cents. Our capital allocation framework is clear. First, we will use cash to maintain and optimise our existing operations. Second, we will retain cash to maintain balance sheet strength and to have funding optionality and flexibility for the future. And third, we will return capital to our shareholders in the form of franked dividends and share buybacks. And in fact, we recently completed an initial 10% share buyback, and share buybacks are expected to remain a feature of our capital management strategy going forward. The board aims to return at least 20% and up to 50% of NPAT to shareholders through dividends and buybacks combined. After these priorities, if there's surplus cash, we'll use that to invest in growth, which may include related M&A or investment in our own development projects. However, if buying back additional shares continues to be more attractive than investing in growth, then our payout ratio may be higher than 50% if there is surplus cash. In FY22, we were the #1 performing stock on the ASX 100. We delivered a total shareholder return of 154%. And in the first quarter of FY23, we continued to perform strongly. We generated a further $1.55 billion of cash in the 3 months to September 22, and the coal price continues to strengthen. We achieved an average coal price of 581 Australian dollars per tonne for the quarter. Weather events and labour constraints have impacted production and sales volumes, but the business has been performing well operationally in an underlying sense, and Whitehaven is well placed to continue to supply the very strong demand for our product that we're seeing. And we see that demand for high quality coal continuing to outstrip global supply for some time to come. And as a result, we expect coal prices to be well supported and Whitehaven to continue to deliver strong returns. We will release our second quarter production report in January, and the following month in February, we will release our half-year results. In the meantime, though, there is more information on our website, including our latest sustainability report. Our sustainability report includes our TCFD reporting, information about our safety and environmental performance, progress against our diversity targets, and the strong contribution we make to the local communities in which we operate and which our people are very proud of. Our contact details are on the website, and we're always very happy to answer questions that investors may have. So we appreciate this opportunity and the interest, and thank you for your time.
Hello, and thank you for joining me. My name is Beata, and I'm the CEO of TruScreen, an ASX and NZX listed manufacturer of world-class medical device for cervical cancer screening. You may have heard that the cervical cancer is one of the biggest killers of women, particularly in the lower and middle income countries. And did you know that Australia is a leader in cervical cancer prevention? And that was Professor Ian Fraser, who led a team who invented the original vaccination. TruScreen continues to hold the baton of innovation for Australia. The technology was developed over the last 3 decades in collaboration between academics in the UK and Australia. And today, our world-class technology offers a simple and accurate screening solution with immediate results, thanks to a sophisticated way of examining the cervical tissue and a proprietary AI algorithm. Over the last couple of years, we have grown our global presence, and despite COVID-related pandemic affecting the globe, we made progress increasing sales in existing markets and commencing sales in our new focus markets. At TruScreen, we believe that cervical cancer will become a rare disease by the end of this century. This does sound bold and super ambitious. While no single company can deliver this mission alone, we are proud to contribute with our unique AI-driven, real-time, accurate screening system. Our technology is an ideal fit for those communities that can't have sufficient access to a conventional lab-based screening methods, which are costly and time and resource consuming. In many lower middle income countries, there are no expensive cervical cancer screening programs similar to the Australian National Screening Program. Our technology will enable those who wish to leapfrog and make progress in cervical cancer screening for their societies. It is most important to note that the timing of our technology is excellent. Recently, the Global Health Organization set targets to fight cervical cancer by 2030 via a combination of vaccination, population screening, and management of the existing cervical cancer. Our non-invasive, real-time screening technology fits perfectly into this paradigm of global cervical eradication. So, what have we achieved in the last financial year, 2022? Despite the pandemic hitting the global distribution channels worldwide, I'm proud to say that we have increased device installations by 20% year on year. We enjoyed 29% growth in our biggest and most important market, China. We rolled out a new firmware and commenced sales in Eastern Europe, another focus market. We had 2 large, independently run clinical trials report excellent results for TruScreen, demonstrating performance of our technology being comparable to the gold standard liquid-based cytology in an advanced clinical setting in China and in Australia. In addition, clinical evaluation in Saudi Arabia and Vietnam have been completed, and we are currently awaiting results. We have also added independent world-class international experts to our international expert group, and we have 5 international experts representing 5 continents. Perhaps most importantly, though, we have received a Made in China mark. So why is MEIC so important? Made in China mark, received in financial year 2022, means that our device is viewed as a domestic device in China. Made in China shortens the sales cycle in China and creates a significant barrier of entry for other similar screening devices that may be wishing to enter the Chinese market. Yes, they can still register their product as a novel foreign technology, but they will be caught up in a lengthy and convoluted provincial and central government pricing approval system, and sometimes receive years of delay. To mention some examples of the opportunities we are capitalizing on in this financial year, 2023. We have recently run our first global virtual symposium for key opinion leaders from 7 countries with 132 registrations. The symposium title was A Place of Advanced Technologies in a Modern Cervical Cancer Screening, and it enabled healthcare professional discussion on this important topic, but also enabled us to share our excellent results from the independently run large clinical trials I mentioned before. Our device has been implemented in the pilot at the National AIDS Council National Government Screening Program for Cervical Cancer in Zimbabwe. We have completed clinical evaluation in Saudi Arabia and are starting a clinical evaluation program in Serbia. And we have just recently received a Polish University of Technology in Łódź, Poland, Mark of Excellence. Our sales remain in growth, and we are confident that in financial year 2023, we will continue seeing growth despite ongoing global challenges. We also kept our business fit and agile. In financial year 2023, we carried less overhead while retaining the core and key capabilities. We have written off our intangible assets, and very recently, we successfully passed 3 quality audits with no non-conformance, and I'm very proud for the team to have achieved that. How will we deliver on our promise of sales growth? We will focus on driving further utilization of our disposable SAS, single-user sensor, or a sheath covering the probe, in our core established markets, China and Mexico, while growing sales of device as well as the SAS in our key focus markets, Vietnam, Eastern Europe, and Africa. We will continue innovating our product as well as our logistical channels, decreasing our costs and increasing the margin. Please allow me to take you briefly through our financial performance and the strategic focus. We increased the product revenue by 48% year on year, as you can see here, with sales growth of 43% year on year. At the same time, saving costs by 22% for financial year 2023. Our net assets have decreased due to the intangible assets being written off, which I mentioned before. In terms of the business growth and how will we deliver that? We'll drive adoption in key and focus markets. We will continue innovating and reducing costs and make best possible use of our excellent clinical evidence. In particular, we'll drive rollout in our more established markets, China and Mexico. We'll drive adoption in Vietnam and Eastern Europe, as well as Africa, while conducting clinical validation in promising markets and collecting more data. We'll make ongoing improvements and continue innovating and making most of our existing and growing base of clinical evidence, sharing this evidence with key opinion leaders, as well as women, educating and engaging through various platforms, including social media and other channels. On this slide, we're showing why to choose TruScreen over the conventional tests or methods used in many lower and middle income countries. It is absolutely clear that for women, the painless and accurate TruScreen examination with instantaneous results in a place of examination in proximity where the woman lives is of great value. For screening centers, particularly in resource-constrained regions, cost reduction in screening due to reduced utilization of medical personnel and costly pathology and colposcopy infrastructure the TrueScreen device and technology is of great interest. This is exactly what we are seeing already, for example, in mass screening centers in China and Zimbabwe. TrueScreen is technology of the near future, and I'm confident that with the WHO strategy and renewed focus of many low and middle income countries on cervical cancer screening, TrueScreen is very well poised for success. So with that, thank you for listening. Do look us up on truescreen.com. Thank you.
Thank you for the opportunity to speak today about our company, BPH Energy Limited. BPH has a series of investments and operates with companies in both the energy and technology and medical devices areas. Advent, in which BPH has a 36% interest, has investment areas in the offshore Sydney Basin, in a joint venture with OMV in the Taranaki Basin offshore New Zealand, and in the RL1 permit to the far north of Australia in the Northern Territory area. All of these are in emerging key areas for energy supply. I'll explain more shortly. We also have investments in clean hydrogen technologies and cortical dynamics. In clean hydrogen technologies, we have a 10% interest currently, and we have the capacity to go to a 20% interest in that company. In cortical dynamics, we're the largest shareholder with a 16% interest. I'm going to speak more on those as we go through this presentation. I'll move next into Advent Energy's investments, and its key investment, in fact, is in the PEP 11 permit. That is, Advent has an 85% interest, and that is offshore Newcastle, with the primary drilling target about 30 kilometres south and east of Newcastle, and about 25 or 26 kilometres offshore. The PEP 11 permit is a gas project, and it covers around 4,600 square kilometres. Newcastle gives us access to an extensive gas infrastructure and pipeline network, and there are 2 gas-fired power stations being built in New South Wales as a baseload power backup into renewable energy. The area itself has a prospective resource of around 5.7 TCF in structural targets. We have a current application to NOPTA to enable drilling as the next step, and a federal court application is pending on that. CCS is a key component of that, and the next slide that I'm going to show you will demonstrate more on that element. If you look at this slide, it shows you petroleum permits across Australia. If you look at New South Wales, there are only 2 residual permits in New South Wales, those surrounding the area of the Santos Pilliga project in the north of the state, which is a coal seam gas project, and the offshore PEP 11 permit. Over the last 10 years, there has been a substantial removal from the New South Wales market of all alternative mechanisms of supply, and the gas shortages that have occurred in Australia in June and July that have brought about intervention by the energy market operator into the power and gas markets in Australia in June and July are key components to understand why this is so important. So important that at a conference last week, the South Australian Energy Minister or Resources Minister said that he would, or his government, would no longer supply gas from South Australia into New South Wales next year if there was a gas crisis in New South Wales. That's a really key element of what's occurring in the Australian gas market at the moment. The other development that has just most recently occurred is that the Northern Territory gas pipeline that supplies gas all the way down into the New South Wales gas system and into Queensland had to be turned off because of problems in the gas supply network in the Northern Territory. When you look at that and the fact that New South Wales requires an extra 70 petajoules of gas a year, and the former federal government and the New South Wales government put $2 billion into an agreement to bring on 70 petajoules a year of extra gas supply into New South Wales, you really understand just how key the PEP 11 permit may be into solving that gas supply network. There are a substantial quantity of businesses and homes in New South Wales that rely on gas for both their energy and operational needs. I'm going to speak more on that, but you'll understand there in the context of New South Wales just exactly how important PEP 11 potentially is in that process. Now I'll move to New Zealand briefly. We're in a joint venture there with OMV. We're currently pending government approvals to proceed with that joint venture. OMV supplies over 50% of gas into the New Zealand marketplace, and New Zealand has less than 5 years, or perhaps certainly less than 10 years of gas for its baseload power backup system, in less than 10 years of baseload power gas supply remaining in all of its fields across New Zealand. So potentially the Taranaki Basin Tutuai well, which we're a potential participant in, becomes a really key component into an additional hydrocarbon supply into New Zealand. I've covered most of the items that I spoke about just now. New South Wales, 300,000 jobs rely on gas supply, 1.3 million households and 33,000 businesses. 85% of the manufacturing of the state's industrial gas load adds 33 billion in industrial value. Without addressing New South Wales' looming gas shortfall, these can be at risk. This prediction has become a reality in the current energy crisis, and that's a really key element. Now, in addition to that, of course, the offshore PEP 11 permit has the potential for carbon capture and storage, or rather the storage component of that. And so that element is key. I'll move now through from the next slide into clean hydrogen. Clean hydrogen in which we're involved is CHT, or in use of methane gas to crack into both hydrogen and carbon black, that is. Its primary advantage over others is its cost, and in particular in relation to steam reforming, which produces around 12 tonne of CO2 emissions per tonne of hydrocarbon produced. So, using the mechanism from clean hydrogen technologies is the lowest cost, cleanest mechanism that there is, and it's the closest in terms of capacity. In fact, if I move to where that company is, and we're talking turquoise hydrogen, they're achieving a 99% purity or lower, depending upon the specification, with their test unit, which is currently in operation and which we're funding. The other element that they produce is clean carbon black, and of course that has widespread industrial usage across the industrial system globally. Now I'll move to cortical dynamics, and I'll just touch briefly on that. Cortical is a brain monitoring system that works during anaesthesia. It has both a depth of anaesthesia measure and a pain measure. The current mechanism, which is registered for CE and TGA and also in Korea, is the depth of anaesthesia, and we're moving to develop and have registered the pain component. We're in a joint venture, or rather Cortical's in a joint venture with, or rather in a commercial arrangement with Philips, with a plug and play agreement in place for the BARM dam, and that's feeding into their display screen, which operates across 50% of all of global operating theatres. Just to finalise on Advent, it's a proven hydrocarbon basin, and it's a gas basin, and that's really important in terms of understanding its potential supply into the network, and also for countering the views that are widespread but inaccurate about its impact on the community. Much more so that there is in fact substantial gas in the offshore area, so much so that there has been huge pockmarks on the outer shelf of the New South Wales Sydney Basin area. And what that slide is there for is really to illustrate this point about the potential for gas coming out of the permit. I'll complete on that, and unless you have a further question, please.
Romana Salotena from Katana Asset Management. What are the biggest emerging trends that you believe are going to impact the year ahead?
Yeah, I think there's probably two levels. I mean, obviously the really big trend is electrification, decarbonisation, and that's a trend that's going to impact not just 2023, but I think the next couple of decades at least. And that's, that's the big daddy of all trends there. I think the more immediate trends that people need to be focused on is the impact of interest rates being driven by central banks finally coming together to fight inflation. I think there's two aspects to that. Firstly is the impact on consumer spending, and secondly is going to be the impact on corporate profitability.
And what are your preferred emerging sectors or stocks in the year ahead?
Yeah, look, I think there again falls into two categories there. I think firstly, in terms of the big trend, electrification, decarbonisation, we've really been working hard to try and identify companies that can benefit from that very long-term thematic. In Australia, which is where our mandate's limited to, it is more difficult to play that theme. We've focused on EV metals, specifically lithium and copper. We think both of those are underestimated in terms of the demand and the impact they'll have. I think lithium now is starting to get some real revaluation and re-ratings, but I think in the area of copper, for example, I think the market has really underestimated just how much copper is required over the next decade if we are truly to reach our goals in electrification. I think beyond that, if you look at the interest rate theme and where that's driving us, I think that it's more about the sectors you want to avoid at the moment. And I think you want to avoid sectors where they're consumer facing. I think the consumers at the front end of a substantial decline in spending. I think we're going to see sales volumes fall away, and I think margins will drop as people try and compete for the consumer dollar. So I think consumer-facing companies are ones we're trying to avoid. I think the ones that we're really looking to continue to gain exposure to are very limited, very targeted. In addition to EV, as I've mentioned, we're also looking at specifically some specific types of energy. So LNG and coal, believe it or not, is actually two of the areas that we see sort of good outlook for in 2023. And also, we're now just starting to do the work on some of the recovery tech plays. A lot of tech stocks are down 70, 80%. We're focusing on the earners, not the burners. So companies that are making good profits as opposed to still burning cash. And we think there's some good opportunities that will probably start to pick off in the back half of 2023.
So finally, what emerging trend do you think everyone should learn about more and why?
Yeah, I think it comes back to that massive, multi-decade theme, which is electrification and decarbonisation. We are past the tipping point, as everyone will be aware now. It is a question of when, not if, and the when is probably going to be a lot sooner than we all think. So I think, the one certainty in our world over the next little while is that we're going to have a more rapid push towards greener forms of energy. And that's going to create some huge opportunities for companies that can capitalise on the technology firstly, and then secondly on the raw materials required for that transition.
Oh, it's a pleasure to be talking today and to be overviewing Antisense Therapeutics. I'm Mark Diamond. I'm the Managing Director, CEO of Antisense Therapeutics. And as the company overview slide highlights, the company is focused on developing and commercializing its drugs, its antisense pharmaceuticals for large unmet markets with a focus in rare diseases. And the reason for directing the focus to rare diseases is that it is a space where the regulatory authorities provide incentives to pharmaceutical companies to develop drugs for these diseases, where generally there are few therapeutic options. So it allows for a more rapid development of these drugs and an accelerated commercialization. So quicker development generally means less expensive development as well too. So we're there because of the convenience and the accelerated pathways that present to us. The other advantage of playing in the rare disease field is that it does typically provide more attractive pricing and significantly less competition. The company has a long-standing collaboration with a company called Ionis Pharmaceuticals. So the drugs that are in our pipeline, the antisense drugs that we have licensed from this company, Ionis Pharmaceuticals, and we have worldwide exclusive licenses to these two drugs for all disease applications. Our partner Ionis have a very successful track record in the development and commercialization of these antisense drugs. They're listed on NASDAQ, have a market capitalization of over $6 billion, have 3 approved drugs on the market, another 30 of these in clinical development and partnerships with some of the biggest pharmaceutical companies in the world. So we're in very good company in having an exclusive arrangement with Ionis as we have. And it does, as the slide here suggests, gives us access to an advanced and thereby substantially de-risked technology from the world leader in the field. Our focus, though, today is in a disease called Duchenne muscular dystrophy, and our lead program that we call AT1102 is focused on boys who are more advanced with this Duchenne muscular dystrophy indication. And Duchenne's is a rare disease, unfortunately, an incurable one, where there's a desperate need for effective therapies. There really are no effective therapies available today. Because of that great need, the market is estimated to grow as big as $10 billion by 2030. We've got a really exciting drug that has shown in clinical trials to be both safe and showing preliminary efficacy, as we describe it, in these boys with Duchenne muscular dystrophy. We are now in advanced planning for a late-stage clinical trial, as we describe it, which we're going to look to run in both Europe and Australia, and we're on track to kick that study off before the end of this year. So it's going to be a very exciting 2023 for the company as we head into this clinical trial. The market opportunity for Duchenne's is enormous. The drug potential for our compound, has been forecast as being multi-billion-dollar. And so it is something that we think our shareholders are, should be very excited about the progress on. We also are focused on expanding the clinical application of AT1102 into other disease areas. So beyond our focus in Duchenne's, we're looking to diversify the company's pipeline by focusing other disease areas. We've shown some preliminary data in an animal model of another rare muscle disease called limb-girdle muscular dystrophy R2. For this indication, there are no approved therapies. These patients have nothing available to them today. And there's about 4,000 patients with the disease in the US. So again, if we can come with an effective agent for treating this disease, presents as having $1 billion sales potential at the premium pricing that is offered for drugs for rare diseases. We're also looking at running a study where we're combining our drug for Duchenne's alongside a drug class that's already marketed in the US today. These are the drugs called the dystrophin restoration agents. In the last quarter alone in the US, these drugs sold over 250 million Australian dollars. So on track to be $1 billion selling dollar category within the US alone. So we're looking at using our drug in combination with these dystrophin restoration drugs in an animal model of Duchenne's to show that the combination, hopefully, is better than just using the single dystrophin restoration agents alone. And so that data we're expecting to report on before the end of this year. We also have a really exciting collaboration in long COVID. Long COVID is, I think everyone on the call here would be aware of, that it is a disease setting or indication where there's a huge need. In the US, there's over 20 million people that are afflicted by this condition where they're suffering the key adverse event of neurological aspects such as brain fog. There is a acknowledged need for a better way of being able to diagnose this in patients. To date, we haven't been able to find any blood markers, as we call them, to be able to definitively diagnose these patients. So we undertook a well-first study where we tested the samples, blood samples of patients with long COVID. We assessed over 7,000 proteins in the blood of these patients, where we identified some really interesting markers that present as both potential diagnostic markers and targets for therapy. And so we filed patents around this new technology and these new inventions. And so we're looking now at being able to commercialize this IP by partnering with diagnostic companies and other big pharma companies to look to exploit that new patents that we've developed in this space. I'm on the slide now, corporate overview. Company has a market cap of 60 million. We're well cashed up, balance sheet as identified there with nearly 20 million in the bank as of June of 2022. Largest shareholder is a well-recognised global institutional investor called Platinum Asset Management. They've been on the register for now over 3 years since we first started our program in Duchenne muscular dystrophy. The stock is well covered. You can see the analysts there that have positive buy recommendations on the stock, all well-regarded biotech analysts in the country. And that research is available on our website as identified there. Last slide then, just pointing to the upcoming key catalysts for the company. Well, of course, there's the progress around our phase 2B clinical trial for Duchenne muscular dystrophy, looking to initiate the trial this year. And in the process, we'll be submitting applications for approval with the regulatory authorities where we're running the study in over 13 sites in 4 countries to complete the study. So shareholders should expect some exciting news flow around the progress of that study into initiation and patient dosing. We're looking to get our positive phase 2 clinical trial data published in a peer-reviewed scientific journal, because we know the validation that comes with having your data reported in such journals is very, very important for the progress of these programs. We're looking, of course, at the combination study with those dystrophin restoration agents, and that data, we've told the market we expect to report in the fourth quarter of this year, so that data is not far away soon. We're looking at running a chronic animal study in limb-girdle muscular dystrophy. Again, this is the disease indication where there are no effective treatments today. So that's going to, we believe, be an exciting opportunity to generate news flow in an indication where there's an acknowledged need for a successful therapy. And lastly, we're looking forward to talk to the further development of our program for the neurological aspects of long COVID. We think that's, again, going to be an important source of value adding for the company and important news flow potential for shareholders to look forward to.
Hi, my name is Niman Fendel, and I'm CEO and Managing Director of Nutritional Growth Solutions. Nutritional Growth Solutions is bringing premium, clinically proven kids nutrition to families around the world. All we do is targeted at kids, and as opposed to some other companies, we're not doing infant formula. We're actually aiming kids products for children over 2 years old and up. All of our products are developed by doctors, specialist pediatricians, and are clinically tested. Another thing that is really important for us is having healthy, clean ingredients in our products. We're already selling in the US, in China, in Italy, in South Korea, and in Israel. Now, when I say everything that we do is developed by pediatricians, we're actually created in Israel's largest pediatric hospital called the Schneider Children's Medical Center of Israel, where a team of expert physicians have been studying the effect of nutrition on kids' growth and development for years. In 2014, the team came up with a formula that has a lot of protein, specifically whey protein, together with vitamins and minerals, and took that into a clinical study to test the effect on kids' growth. What we saw is that after 12 months of intervention with our special formula, the kids who had this formula, which is called Healthy Hearts Grow Daily, they grew significantly more in height. In fact, they grew about 25% more in height, which is quite amazing, taking into consideration the fact that this is no drug, it is just very specific targeted nutrition. Now, this category that we're operating in is called the grow up milk category. And this is basically what you would look at as infant formula for older children, ages 1 year and beyond. And this is the fastest growing category in this market. In fact, it was evaluated in over $20 billion in 2020 and is continuing to grow quite rapidly. If you look at what our competitors are doing in this market, for example, our biggest competitor is called Pediasure by Abbott Nutrition. They're doing over $1 billion a year in the US alone in sales. So this just comes to show how big the opportunity is if we just execute properly. In terms of our revenue growth, we have been able to grow our revenue quite nicely with a 3-year revenue growth of 480% over time. Now, if you look at our revenues to date, this is just created by online sales in the US. By the way, all of our revenues are being reported in US dollars. And one of the key things for us as we're growing the company is maintaining very attractive gross margins of over 40%. I think for me, being able to grow the company into profitability sooner rather than later, especially in this market, having these strong gross margins is going to be key. Over the past 12 months, we entered the China market. We signed some distribution agreements globally. We entered what we call retail.com in the US, so that would be Walmart.com, Kroger.com, and others. We started selling in South Korea, and just recently, we also started sales into brick and mortar stores in the US. And specifically, we're now selling into Walmart in the States, which is the biggest employer in the United States. We are now selling into 403 stores, Walmart stores in the US. These are the A+ stores. So it means these are the stores that are in the most affluent neighborhoods. And just being able to grow within Walmart, because Walmart has actually 4,000 stores in the US. So just having the opportunity to grow from 400 stores to 4,000 stores and growing from 2 units that we're currently selling into Walmart into 10 or even 20 units in 2023, this is going to be a huge opportunity for us just within this specific retailer. Now, for the next 3, 6, 12 months, what can you expect from us? We will continue to execute on our 3-pillar growth plan. And this is going to be around products, geographies, and sales channels. When I talk about products, I introduced you to our flagship product, which is for kids 3 to 9 years old. But we also introduced the market into a new product for children 10 years old and up, and are now working also on a product for athletic children to improve their sports performance. In terms of geographies, China is going to continue to be a big focus for us outside of the US. So China is a huge opportunity for our business. We actually have a new board member called Peter Osborne. He was the GM for Blackmores in China and Southeast Asia. And together we are working to build a plan to unlock the China market. The third is going to be adding more sales channels, and specifically it's going to be more retail stores in the US. Now, our company has built itself on being an e-commerce online sales business. But even after COVID, even in 2022, retail in the US is still the king. So if we want to grow this company from being $5 million in sales to 10 million to 20 to $100 million in sales, the quickest way to do it is going to be through adding more stores in the US. Now that we have Walmart as well as Healthy Edge, which is another more natural premium banner that we're selling into, these discussions that we're having with other retailers is much easier, and we do expect to be in more retail stores by the end of 2022 and definitely more retail stores during 2023. Thank you so much.
Hello, I'm Jason Bodson, the President and CEO of Tempus Resources. Tempus is an ASX-listed gold explorer focused on flagship project in British Columbia in Canada. We're also listed on the Venture in Canada and on the OTC. About 236 million shares out, current market cap about 14 million. And we're fully cashed up for our current drilling program with $2 million currently in the bank. The company has a very strong sort of board and management. The board is led by Alex Molyneux, who has a great track record in Australia with Galena, Argosy Minerals, a Metalla royalty company in Canada. Myself, I'm a mining engineer with about 30 years of operations, finance, and I've lived many years in Australia and elsewhere. I'm based in Vancouver, along with our geological team on the project is based here in Vancouver. As I mentioned, our flagship project is the Elizabeth Black Dome project in southern British Columbia. It's an emerging pioneer Braylorn gold camp. We have an existing mill on the project claims, and we're currently drilling the Elizabeth, which is a orogenic deposit. The target is near-term production, near-term cash flow. The existing mill, as I mentioned, is 200 ton a day. We've completed a restart study of that mill, and we're targeting about 20,000 ounces of production, pending further studies and completion of the resource. The historic resource, which is about 206,000 ounces at Elizabeth, is being upgraded, and we're planning to come out with a new resource statement, which will be NI 43-101 and JORC compliant in Q1 2023. Now we've completed over 19,000 meters of drilling, about 70 holes since that historic resource, which was done in 2009. It's very high grade, narrow vein, vertical veins. We have multiple bonanza grade intersections with grades up to 1,572 grams per ton, or approximately 50 ounces per ton. And the vein widths tend to be between 1 and 5 meters. In the overall area, we're very close to Talisker Minerals is another comp in the area, and West Haven as well. So it's quite an active area with synergies both on the corporate and operational side. Over the next 12 months, we have several key value drivers. As you can see in this slide, we have multiple veins under development. They're vertical. They're quite close to each other, about 120 meters apart. Typically, they are open at depth. And we've over this year, we've drilled 40 holes in 2022. We have assays pending on 27 of those holes, including very high-grade holes in the number 9 vein, where we reported visible gold intersections recently on hole 19, hole 20, and hole 28. We also have a visible gold intersection in hole 36, which is still assays pending, which is on the blue vein. So we have a multitude of assays, exciting assays coming over the next few months. The turnaround time on the assays tends to be about 2 months. So we'll be reporting assays well through to the end of the year. We're working on the preliminary work for updating our resource. The previous resource was in 2009, about 206,000 ounces on Elizabeth. We've now completed the QA/QC samples required for coming up with an independent resource estimate, and we anticipate that will be completed in around Q1 of this year. We're also, this, as you can see here, here's a picture of our mill on this slide, which is 200 ton a day. We've done metallurgical studies on that mill using Elizabeth core that show recoveries up to 95%. And it is an existing, the mill was run for 5 years from 1985 to 1991, produced about 230,000 ounces of gold. And that mill is got a gravity circuit followed by a flotation circuit. We've looked at the metallurgical recoveries using Elizabeth core, and we've also done a detailed engineering study of the cost, restart costs, the capital and operating costs to restart that mill. And we'll be releasing that, the results of that study once we have updated the JORC NI 43-101 compliant resource. And, I think we have a very attractive valuation compared to our peers, and encourage people to look at Talisker Resources, look at West Haven. The tickers are shown here that are substantially higher sort of valuations than Tempest currently is right now. I think part of that is getting the story out into the North American market and the Australian market, and just so I think there's a potential opportunity there as well to capture value. So it should be a very exciting period over the next 12 months with many milestone events that we think will drive value for the Tempest story.
Okay, my name is Simon Matter. I'm the Managing Director and Chairman of Prime Financial Group. So today, let's start with who we are. What's Prime all about? So first of all, we are a firm operating across 4 key areas, being accounting, wealth, corporate advisory, and SMSF. So in totality, we're an advisory and capital firm with 130 people operating across Melbourne, Sydney, and Brisbane. And we run a centralised services structure out of Melbourne for IT, finance, HR, and marketing. And this has allowed us to scale our firm in particular over the last 4 to 5 years. But our overall purpose is all about empowering our clients and our team to achieve their aspirations. Let's talk a little bit about the financial highlights for 2022. So impressively, the team were able to deliver a 15% increase in underlying EBITDA, an 18% increase in revenue. That's all been organic revenue growth. An improvement in reported EPS, up 14% to 1.93 cents per share. That would have been up slightly higher if it hadn't been for the subletting of our Melbourne office space. So it would have been closer to about 30%. But we also increased our full year dividend. That was up 57% to 1.1 cents per share. We maintained our operating margin at 30%. We reduced our debt by 26% to about 0.7 times underlying EBITDA, or debt of $5.2 million. And we continued to increase or improve our operating cash flow. It's actually up now almost 4 times from 2019, but it was up 11% to 6.1 million in 2022. Impressively, since we have repositioned the business in 2018, Prime has had consistent growth across all of our key metrics. So underlying EBITDA has increased from about 3.7 million in 2018 to 7.8 million in 2022. The reported profit after tax has gone from a loss to a profit of 3.8 million in 2022. EPS has gone from 0.77 to 1.93 cents per share. The dividend has increased. It's increased to 1.1 cents per share in 2022, up from 0.7 in 21 and 0.45 in 2020. And the share price has increased from 12.5 cents in 2018 to 17 cents on 30 June 2022. But today it's currently around 24 cents. So how are we growing this firm? So our goal is to increase our revenue from 26 million to 50 million over the course of the next 3 years. We're going to do that across 4 key areas from both an organic and inorganic point of view. And recently, in fact, actually on the 4th of October, we completed an acquisition, which I'll talk a little bit about in a moment. But organically, this has been impressive what we've been able to do over the course of the last 4 to 5 years. Across all 4 service lines in FY22, so accounting, wealth, capital, and SMSF, we increased organically how we were growing those areas. Now, we're doing that in a couple of key ways. We've got partners in our business that are out there finding new clients, and we're also delivering additional services to our existing client base. We're also doing another thing, point 2 here. We're attracting new revenue contributors. They're people like accountants or advisors that have an existing client base, and they're looking to join a group like Prime that has additional services and a place where they can start to earn some equity in our business. That's an important key differentiator for Prime, and it's worthwhile noting that 44% of the ownership of Prime is by key management and staff. All team members, after being with us for 12 months, start to earn equity, and that's a key way that we're trying to attract talent within our business. We'll also do point 3, which is continuing to roll out new service lines. The 2 most recent service lines that we rolled out were corporate advisory 5 years ago and SMSF around about 4 years ago. And I'll show you the trajectory of those 2 key service lines on the next few slides. Acquisitions, as I mentioned before, is the 4th pillar of our growth strategy to get to 50 million of turnover. And we were really pleased to complete that transaction being Intello in the SMSF space. And I'll talk a little bit more about that in a moment. So Intello, as I mentioned before, the 4th pillar of what we do is SMSF. And within that space, we have identified a great business that we acquired on the 4th of October. It generated or generates $3 million of revenue. It will contribute around about $900,000 of EBITDA for our business. It's highly EPS accretive. The purchase price was 4.6 million, with 70% paid up front and 30% in the 12 months following. But importantly, what this has done for our SMSF division is provide us access to a whole new client base and also to scale the SMSF revenue as part of group revenue. SMSF revenue will now go from being 10% to 20% over the following 12 months. So let's take a quick look at the 4 key service lines I mentioned before and how they've been growing over the last 12 months between 21 and 22. You see accounting and business advisory has increased by about $500,000 over that period of time. So good organic growth, 5 to 10% there. We've also seen the wealth management division, which currently has about 1.1 billion of funds under management, increase from 7.6 million in 21 to 8.5 million. So that $900,000 increase has been pretty significant growth. The corporate advisory division, which has been only established in the last 5 years, is now turning over $4.5 million and is a key way that we differentiate in our core client segments of businesses, corporates, and also family groups. SMSF I've mentioned, so I won't touch on that in any more detail. Obviously, as part of our total shareholder return, we look at what the share price might be, but we also look at the dividends that we pay to our shareholders. And you'll see on this slide here, we've had a great trajectory over the course of the last 3 to 4 years. And we are forecasting that our dividend will increase from being up 57% in 22 to being up a further 36% in FY23. We pay out about 40 to 60% of our earnings, and we paid out 52% in FY22. With respect to our outlook for FY23, we are seeing continued growth. We are seeing or expecting to see revenue grow by a further 15% in FY23. We're expecting our underlying EBITDA to grow by 5 to 10%, EPS 15% plus. We'll continue exploring all 4 of those opportunities we've seen across the different areas that I mentioned before, inorganic and organic. We see about 60 to 75% of our growth coming from organic initiatives and the remainder inorganic. As I've mentioned, the dividend will be up a further 36% in FY23. Debt will remain modest at 0.5 to 1 times underlying EBITDA. We'll continue with our buyback that we've had in place for 12 months. And we'll also focus on making sure that our team are aligned with great client service and ensuring that they have an ownership stake in the future we're trying to co-create together. So how we think about our investment case at Prime is really in these 9 key final points. So continued growth in earnings and a diversified recurring revenue stream that allows us to make longer term decisions about our growth. We'll continue to maintain strong margins at 30%, plus or minus 1 or 2%, and good cash flow. We've done a recent transaction which is highly EPS accretive for us, being Intello, which I've mentioned. There'll be further opportunity for M&A, and we'll be able to scale our structure to ensure that we're able to drive the right amount to the bottom line. The buyback will continue, and we are in an industry, point 6, that has continued growth around professional services. Importantly, also in times of distress or challenge, in particular over the last 3 years, we've seen our business grow through the pandemic because people need advice. Dividends will continue to increase as mentioned. And interestingly, we are trading at a lower multiple than our peers. So that presents an opportunity for continued share price improvement. And as I mentioned before, having the business 44% owned by key management staff is a really important differentiator to attract and retain talent. So that's the investment case for Prime, and that's what we see over the next 12 months and a great opportunity to participate in that. Thank you.
My name is Scott Farthing, and I'm here to present to you as CEO of EVZ Limited on the Capital Network. I'll provide today a general overview and update on EVZ and our businesses and where we are taking each of these businesses in the future. Each of our businesses are in the engineering and technical services sector, supporting large industrial players achieve their capital development and operating goals. Whether we are designing, constructing, supplying, maintaining or servicing engineering systems, we are here to deliver safe, quality outcomes for our clients. EVZ currently owns 4 market-leading businesses. They are Brockman Engineering, Siphon Systems, Tank Industries, and TSF Power. I'll now take a few moments to give a brief description and overview of our businesses. Brockman Engineering serves the liquid fuels, chemical, mining, and water industries. Brockman designs and constructs large storage tanks, pressure pipe networks, and other large steel fabricated items, such as pressure vessels that are used in the storage and processing of fuels, water, gas, and chemicals. Brockman's clients are generally blue-chip industrial companies such as ExxonMobil, Ampol, Viva Energy, United Petroleum, Rio Tinto, Melbourne Water, Sydney Water, and Greater Western Water, and many other major clients. The Brockman team comprises more than 150 employees from their headquarters in North Geelong, where they operate a large fabrication workshop to support our project work and the local industry such as the Geelong Energy Hub, the Geelong Refinery, Incitec Pivot, etc. We employ engineers, technicians, planners, tradespersons of varying skills to deliver quality outcomes that are very, very safely. Brockman are currently actively involved in the large fuel storage enhancement program being supported by the federal government. The program is called Building Australia's Diesel Storage Program, or BADSP. And the objective of the program is to increase the volume of diesel fuel stored on Australian shores to protect our country and economy from oil shocks, which may prevent fuel supplies from being brought on shore from overseas refineries. The program is targeting to deliver 780 megalitres of new diesel oil storage on Australian soil to be ready to be used by 2025. The total expenditure on this program over the term during the program is expected to be $520 million. Let's talk Siphon. Siphon Systems is the leading siphonic stormwater drainage company in Australia and Asia. Siphonic stormwater drainage systems are a more efficient and technologically advanced way of collecting and draining stormwater from the roof of large buildings. Siphonic drainage systems have a unique technical advantage that make it more valuable to the building designers and owners, giving their assets a higher protection of flooding risk. The technology suits buildings of 2 stories and above, or a 5 metre roof line and higher, and is commonly applied to large shopping centres, warehouses, factories, stadiums, offices, and apartment buildings. Siphon employs more than 200 people from across Australia and Southeast Asia, designing and installing these unique systems to new and existing buildings. Siphon has a dominant market share in both its markets, being around 80% in Australia and 70% in Southeast Asia. Siphon is expanding its market share as the construction industry transitions from conventional gravity drainage to siphonic drainage. Siphon is also expanding in Asia to new countries and regions as each of those countries in the region opens up following the pandemic. Tank Industries is our newest company in the group. Tank Industries has been acquired in the past month and is currently undergoing the integration and transition process into the EVZ business model. Tank Industries is a leading water storage tank provider to the building, manufacturing and industrial sectors. In conjunction with Siphon Systems, Tank Industries is able to provide packaged tanks, pumps and other water supply and water efficiency products to meet our customers' ever-expanding needs. We see great upside for this business. Water storage tanks are used in almost every commercial building in the domestic cold water storage, fire water, recycled water, and stormwater detention in urbanised developments. We expect to be able to expand Tank Industries' market share through Siphon's clients, which should increase markedly over the time. Our business in the transition to the renewables sector is TSF Power. TSF Power is an up-and-coming business in our group. TSF Power provides technical services such as generator sales, spare parts, operational support, maintenance, workshop servicing to the equipment used to deliver electricity from the waste or gas or biogas derived from landfill, wastewater treatment, mining and industrial digestion processes. Overall, the scale of businesses in the EVZ group are, using 5-year average revenues, Brockman $40 million per annum, Siphon $21 million per annum, Tank Industries $7 million per annum, and TSF Power $7 million per annum. In 2023, we're expecting revenues to increase from these levels, in particular at Brockman, where we expect revenues to exceed $60 million. Each of the other businesses are expected to grow by 15% on these bases. This diagram provides a breadth and width of our businesses, principally Australia and Asia, with personnel in capital cities to serve our clients' needs. In total, EVZ has more than 400 staff spread across these regions. On a geographic distribution and maximising our exposure to the best opportunities region, we do expect in coming periods to increase our footprint in Southeast Asia, as each of these economies return to normal after the pandemic. The EVZ strategy going forward is to increase shareholder value through further development of our current businesses, through profitable growth and investment. But we're also very keen to continue along the acquisition pathway for new technical services businesses where we believe we can add value through improved strategic execution and synergies to improve overall results and performance. Our summary of the way forward is growth and scale. Scale up strategy is the forefront of our strategic agenda. Scaling up through organic growth driven by tailwinds of increased expenditure in our industry, and bolting on acquisitions where we feel we can add value to the business upon acquisition and transition into our group. Our balance sheet strength and improved capital position provides flexibility to drive scale in our business. We currently have no debt, and our view on the way forward is to maintain this no debt status. There's a supportive macro environment in our industry and across the economy. We have a strong pipeline of opportunities from increasing infrastructure spend in Australia and across Asia, and in coming years we see that to continue. The industry is experiencing reasonably stable tailwinds which are likely to be maintained for a few years to come. Our ability to execute. Well, we have highly skilled workforce with the ability to attract and retain and maintain a growth status. Our business have a strong employment reputation in Australia and Asia for managing the employment, career and team experience at a very high level. EVZ Limited revenues in the financial year 22 were $67 million, and we're expected to grow by between 30 and 40% for the financial year 23. Thank you for your time today.
Thank you for joining us for the Capital Network's Emerging ASX Gems Investment Conference. If you like what you've seen, please be sure to like and share the video, subscribe to TCN across all our social media platforms, and drop us a comment. Tell us who you would like to hear more from or be connected with, or if you're an investor, send us an email so we can keep you in the loop with the latest emerging ideas. To keep updated with all our developments, follow or subscribe to our social media channels. For now, thank you to our presenters, contributors, team, and importantly, audience. We value this community and we really want to see it thrive and wish you all the best in your investment journey.